All right, everything looking good. About to go ahead and get this started. Okay, great. Welcome back to the channel, Crypto Trend Trader, with our Wednesday evening market look ahead or update. It is currently 8 p.m. on Wednesday, August 4th, 2021. And we're going to take a look at some assets today, run through the list. I'm going to look at a couple fresh ones, some requests, and also dig a little deep. Also got some cool new stuff that I'm going to be providing to the community here soon, especially the members of the trade group. So keep your eyes peeled. Make sure you like and subscribe if you're new to the channel. Before we get started, also, I'd like to remind you, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. All right, great. So I had another nice little day in Bitcoin after a couple of days of basically like sideways to down action. We'll jump into that shortly. While the spot market looks decent, our futures market looks a little bit better. So but let's get started where we always do and take a look at our 10-year treasury yields, TNX on the daily. We'll notice we have just come down here, found support exactly where we expected in the green box here. Got a nice little reflex rally off of it. Got denied by the 200 exponential and simple moving average. Rejected at our dotted heart line here. And now we've pushed back down to that same level. At this point in time, what I'm paying attention to is, does this level hold? We consolidate here and then get a push back up? Or is this 200 exponential and simple? The longer basically that we stay underneath these, the more likely it is we're just going to get smashed down to our next key level, which is our blue box area down here, our next support zone. And at this point in time, it's looking more and more likely that we are headed down to like the 1% treasury yields on the 10-year. So we'll have to wait and see how that plays out. But at this point in time, we're seeing weakness on the daily. We're looking like we're about to get the cross back down and a rejection from like our neutral area at the 50 right here on the stochastics. And more than likely, the 200 exponential and then the simple afterwards are going to roll over. The only way we can avoid that is if we get back above 1.3, consolidate there long enough, and then we can continue to move up. And then obviously, if we look at our weekly chart, we will see on the weekly we have gotten the 821 cross to the downside on the weekly. We are inside the bearish control zone. We've got nothing but bearish or red histograms, and now we are well below the slope line. And if we stay here long enough, the slope is going to flip back over to red. And you know, again, this is completely expected. This is what we would expect to happen in this situation. We basically came all the way up, got rejected off of our, let's get rid of our drawing tools real quick here. Got rejected off of our 200 exponential moving average. Now we're coming back down to consolidate. I do expect eventually for this to consolidate and then move to the upside. But for now, everything is pointing to the downside on the short and medium term. And finally, if we switch over to our monthly chart, just to keep this in mind as well. On the monthly chart, we are very close to essentially confirming a rejection of the 821 cross to the downside. Again, I would expect us to come back down. We essentially sold off from back here November 2018, came all the way down and bottomed in March of 2020, and then we retraced back to the upside. That's our yellow Fibonacci levels right here. We made it somewhere in between the 618 and the 786, but if we zoom and then obviously when we came back down, we're currently finding support at the 0.5. So we overshot the 618 slightly, and now we're coming down finding support at the 0.5. But if we zoom out a little bit and we look at the red Fibonacci level, which obviously is much more heavily weighted as it goes all the way back from our 1980s high back here at like over, I mean, it was like 17% or something like that, 16%, somewhere around there. Yeah, just about 16%. That was like Paul Volcker jacking up interest rates to kill, you know, all the craziness in the economy, get rid of all that cheap money, all the dead businesses, and, you know, basically force out the bad. You know, that's kind of what we need at this point in time. We need like that burn to clear out all the junk so that the good businesses can take over and like the strong can survive. But we don't do that anymore. So obviously, you know, we've been in a strong downtrend on rates since then, including down here when we actually hit close to zero, like 0.5, which was an all-time low, obviously. You know, obviously there was a lot of fear in the markets, and then on top of that, the Fed setting the Fed fund rate at zero is going to artificially, you know, deflate the interest rates and cause like everyone to flee to bonds. And you know, obviously all the uncertainty in the markets and everything, people ran to bonds in the United States because that was like the safety play. So but if we go all the way from the top of the range there to the bottom of the range here and put our zero in place, assuming that is our swing low, like you know, essentially we can't go much lower, but we could essentially get down to zero if we you know, if we continue down this course. But essentially from then we got the bounce back up, and we found like a resistance at the 0.5 level, tried to push up higher, and that was our top from 2018. And then from there we went all the way down to the bottom. And then obviously when we came back up to the 382. And if we got rejected at this 382 in red, we would expect to come back down to the 236, or in between like the 382 in yellow. So essentially, you know, somewhere around this blue box area would give us the target for both those. So perhaps it's more realistic, actually. Perhaps it's a little more realistic, actually, if we move this down in between those two levels, as that's really the target area, because it's going to give us the confluence between our two different like fib targets. So that would be the 236 in red, and then also the 382 in yellow. At which point in time, I would expect once again a reflex rally, and then to see what happens with price action from there. But do we have to get down that low? No. Do we have to find support if we do get down that low? Also no. But that is what I'm expecting right now. And then if we switch over to the TLT, this is a 20-year treasury. So we're basically looking at like the inverse of that same chart. You know, we're looking at basically a large head and shoulders pattern. We've come up and essentially put in potentially the right shoulder. At this point in time, we're consolidating above what amounts to our top right here, to our pullback down here, and then we are basically just shy of the 0.5 Fibonacci level. I think it's much more realistic when we do top out. If we do top out, it would be at the 0.5 or at the 618. Not just kind of out here in the middle of nowhere land. So at this point in time, it looks like we're just consolidating on top of the 382 now. If we consolidate here long enough, I expect us to push up to the 0.5. But if we break that back down below this level, you know, I would expect potentially a retest of the 236 or the heart line. But again, we'll have to pay attention and see how that plays out. You know, obviously on the shorter time frames, it does look like we're potentially, you know, topping out in this area. We'll have to see. If we come in and put in a new high here, we could develop some divergence on the daily. It's definitely a possibility. If we switch over to our weekly, we can see obviously though, we have all green histograms strengthening to the upside, well above the slope line, inside of the bullish control zone. So obviously inverse of the treasury yields, bonds are looking very strong right now on the weekly. And then finally, if we look at our monthly chart, this is where we start to see once again the weakness coming in. This is all red histograms in a row. We have a couple of green histograms showing up, but we're well below the slope line now on the TJD, TDMACD. And if we stay down here long enough, which I think is more likely than not going to happen, this will flip over to red and we'll enter into like a longer bear trend and probably hit our target down here. Initial target being close to like 130. And obviously still in a downtrend on these stochastics, and more likely than not going to be entering into the bearish control zone as we basically just bounce that level with this initial pushback up here. So more than likely though, I think this head and shoulders will play out, but we'll have to wait and see. A lot can obviously change. The most important thing is to stay fluid with our technical analysis, and you know, whatever the market decides to do, we're going to trade that accordingly. I do want to look at the VIX chart today, something that obviously I look at fairly often, but have not brought up on here for a while. So essentially on this chart, it's obviously a little different than what you're normally going to see, but basically what we have going on here is, you know, I have set in from the low area, which would be our support area, and then our high area, which would be our resistance area, a channel, the heart line obviously here at the dotted line, and then we have essentially a like very bearish zone down here where we have bottomed out in the past only 3 times. 94 we bottomed out down here, 2006 we bottomed out down here, and then 2017 we bottomed out down here. And then this is obviously the volatility of the S&P if you're not familiar with it, and you can pull it up on your own with VIX. And then you'll see here at the top we had a couple of tops back here in 99 and 2002, and then we had a all-time top and you know, the most volatile it's ever been, which was 2008. Obviously these correspond to, you know, massive instances like financial crisis. You know, 98 to like the 2000 range around here was obviously the financial crisis, the you know, dot-com bubble, etc. This was our 2008 housing crisis, and then we had a couple other times when we peaked up in here, just from like volatile events, and then finally we have you know, the most recent event, 2020. And essentially all this is telling us is like the volatility inside of the stock market, you know, which obviously you can use to trade, but it tells you typically when people are unsure about something, the volatility is going to pick up. When everybody's confident, volatility is just going to kind of like slowly taper off. So when we had I'm on the weekly now, this was our March 2020 volatility, obviously picked up immensely as people were, you know, afraid of everything, selling off everything, didn't know how long it was going to take to recover. Since then, we have basically just been kind of like bleeding out back down to like reasonable levels. Now we're below the heart line, which has been acting as resistance. It was very clearly here, support, very clearly here, support, and now here it's been acting as resistance these last like 3 times we tried to test it. Now, you know, I would expect this to continue playing out inside of our channel right here. Let's go to a shorter time frame. Now we're on the daily. We can get a little more realistic of a picture. You know, we had obviously the very volatile move, and then we've just been operating inside of this descending channel since then. So more than likely what would eventually happen is we'll continue inside of this channel until we don't. We're obviously spending more of the time in the bottom half of the channel, especially like more recently. The majority of this year has been spent in the bottom of the channel. I would expect us to continue operating inside this channel, and then eventually, you know, just because of the way the VIX operates, it's always going to essentially operate between, you know, a 0 and a 100. It's never gotten obviously to 0 ever before, and it's never gotten all the way up to 100, although it got extremely close to both those things at times. So this is always going to operate inside of that range. So right now we're operating about like 17, 18. I would expect this to keep like bleeding out as long as, you know, everyone stays bullish on the markets. There's no fear or anything. If all of a sudden the fear starts to come in, if all of a sudden volatility starts to pick up, I would expect us to retest the top of the channel. If we retest the top of the channel and start hanging out above the heart line here, which obviously we have strong resistance with both heart lines, I would expect to move back up into this range. So if we get down into essentially the green zone right here, I'm going to long volatility. If we get up inside of the red zone right here, you know, I would basically short volatility, as you know, you're expecting it's only going to be able to operate inside of one of those highlighted areas for so long. So right now we're obviously in the bottom of the range, but not extremely low by any means. As you'll notice that when we zoom out at the big picture, we operate the majority of the time inside the bottom of the range. As people are confident in the stock market typically will just go up. So naturally you would expect volatility to be overall tame. And then when we have like these scares is when you see the spikes come up here. So I have a feeling, you know, that sometime in the near future, we're going to see some kind of spike here. But what does the near future amount to? I mean, it could be sometime in the next year. You know, we really don't know at this point in time, but it is important to pay attention to this and how it operates and corresponds with like everything else going on. But as far as I'm concerned right now, this is fairly tame. I expect it to remain tame unless we see like some craziness, like some fear affiliated with like, you know, the delta and whatnot. So let us switch over and take a look at the DXY, and then we'll just jump straight into some technical analysis on our traditional assets. And if you're new to the channel, make sure you like and subscribe. We do streams every Wednesday and Sunday, and then yeah, pretty much any requests, anything like that, if you'd like anything in particular talked about as far as, you know, technical analysis, stocks, crypto, all that good stuff. But DXY is next. You know, obviously everyone is extremely bearish on DXY right now. We're starting to see people like kind of switch their tone a little bit. At this point in time, we basically had a nice push up, but what amounted to essentially a key resistance / support area through here. We retested it and got rejected by the 200 exponential and simple moving average in blue here, and then we finally were able to get back on top of it. We got rejected at that same level again, which basically is starting to develop a very clear W pattern, or you could say that this is like an Adam and Eve bottoming pattern, or alternatively that we have basically a head and shoulders with a slight slant to the downside. Now for me personally, part of what I determine trend with is I look at the time frame I'm on, which in this case is the daily. I look at the 200 exponential and simple moving average, which is the bright blue and dark blue right here. I look at where price action is in comparison to them. So we are currently above the 200 exponential and simple. I then look at the slope of those moving averages to determine trend. The 200 exponential is basically flat or slightly sloped to the upside, and the 200 simple is very, very close to flat, and obviously would eventually slope to the upside if we stay on top of them for long enough. The reason I like to look at this as our trend determining factor is it's very effective no matter what asset you're looking at. If we go back to basically the last time we broke down below the 200 exponential and simple and they curved to the downside, that was right back here in June of 2020, and the dollar has been weakening in a downtrend since then. So very obviously this was a 1-year trend. So if we're looking at something on a daily and we have a 1-year trend, and we're just now looking at potentially flipping it back to the upside, that gives us a nice long period that we can trade with the trend. So throughout this entire time, we know the trend is now officially down once they are sloped to the downside. So what we want to do is we want to be trading with the trend. So while we'll see occasional pops to the upside or occasional strength in the DXY in comparison to other currencies, we would expect overall every move to the upside to be met with an equal or larger move to the downside. And then once we got to this area here and we started putting in essentially a double bottom, we identified some key divergences on different time frames, and obviously some bottoming looking patterns started to level out after the first rejection here and then got back on top of it. So now what I'm expecting on the DXY is for the dollar to strengthen here over time. You'll notice this last push up here, again, everyone was getting very bearish here. We did get the 821 cross confirmed, but we pushed back up here and are now attempting to save the cross. If this gets rejected and we push to the downside, the target would be back down to the 200 simple moving average. But if this does start to consolidate here and strengthen, it's going to roll over our 200 exponential and simple. We're going to confirm that the DXY is now in an uptrend in relationship to the basket of currencies, and we would expect this to strengthen, and then that has the inverse effect on our asset markets. So we would see obviously the dollar strengthen, which would mean that we're going to see like foreign currencies in the basket, and typically it gives us a accurate representation of like world currencies in general. While you'll have some outliers and the basket is only 6 currencies, it's primarily like the main ones that actually matter are the Canadian dollar, the British pound, and the euro. So they make up the majority of the basket, and then obviously everything else out there also has its own chart in relation to the dollar, but they can overall give us an idea as to what like foreign currencies are doing. Obviously you're going to have some outliers like the Turkish lira or whatever, but this gives us an overall broad look at the market and what's happening with the dollar. So, and it's important to compare them to the dollar because it's a world reserve currency. So if this is in fact correct, and we're going to start strengthening to the upside now, it's basically people going into the dollar because they're afraid of their own currencies, or there's too much uncertainty in the world, so they're fleeing to the reserve currency, or they need to make settlements on positions or loans or whatever that they have, so they need to settle with dollars because that's what the debt is denominated in. Or alternatively, they're afraid like asset markets or whatever are looking extremely volatile, or there's potentially like fear in the markets, so people are leaving like traditional stocks, commodities, cryptos, whatever, and that causes a strengthening dollar, as basically people are pulling their dry powder to the sidelines so that when the time comes they can deploy it again, which would lead us to like once again a strengthening dollar. So if we look at the weekly chart on the DXY, again, it starts to look very clear that we have like a W bottoming pattern right here, and then obviously we have the previous low down here, and then we have a higher low, series of higher lows right here. So essentially, if we look at this on a longer time frame now and we pay attention to the weekly time frame, we can kind of see what's going on here. And now look, is this going to stay into a long-term downtrend or uptrend? Because basically we were in a downtrend. We broke above that downtrend here on the weekly back in 2012, went like pretty parabolic after that, came back down, tried to find support, found some support, came up, put in essentially a lower high, and now we have broken back down below the 200 exponential and simple, and they now have obviously sloped to the downside, and we're below them. So essentially what we need to find out is this going to be a double bottom, push up to like the 95 range, retest the 200 exponential and simple, get rejected, and then continue to the downtrend? or is it going to find support right here, break back above them, and then this was essentially like a false alarm, something like what we got back here, where we broke down below them, and then we were able to recoup that area. Even though we did put in a lower high right here, you know, we still basically are staying in a shorter term uptrend, but midterm, not necessarily. And then if we switch over to our monthly, this is where the true trend comes in. Obviously, the longer time frame, the more substantial it is. This is what really makes me think that the weekly could have been like a fake out or just potentially a consolidation period is. We'll notice again back here in 2002, we went into a downtrend. This has very clearly been in a downtrend its entire life. From 1986, this chart goes back to, that was a high. We had a high back here in like 2001. We had a low here in 92. We had our last low back in 2007, and now it looks like we're potentially putting in another lower high right here, continuing the downtrend. But something has changed now. Now we had the 200 exponential and simple here and confirmed a downtrend back in 2003, but now we've broken above the 200 exponential and simple here. This was our retest of the 200 exponential and simple, was that low back in January of 2018, and then we bounced, put in a lower high, which normally would say, oh, okay, that's bearish. It looks like a double top. We're going to sell off from this area. But since then, we came back down and we actually put in a higher low. So if this area holds right here, this is going to look like a consolidation pattern, which you could call it neutral, or you could say it's going to be slightly favored in the direction of the predominant trend. But regardless of that, the most important thing is, for the first time in this chart's history since the 1980s, we now see a confirmed positive slope on the 200 simple moving average and a confirmed positive slope on the 200 exponential moving average. So on the monthly most significant time frame, we've identified what amounts to a double bottom pattern, a low followed by a higher low scenario taking place right here, a high followed by a higher high scenario taking place right here, and then we're confirming that we're in a monthly uptrend. We also have a hard buy signal and exiting the bearish control zone, and we have 3 months worth of positive histograms on our TJD TDMACD. So what that tells me is that this trend is actually just consolidating right now on the longest time frame or longer time frame, and that this is in fact probably more than likely technically going to be moving to the upside. The next key resistance obviously is to get above the 21 moving average in yellow, at which point in time, if we consolidate above there long enough, the 8 and 21, the red and yellow across to the upside, and then I would expect the trend to last for some time after that. But that is how I'm looking at it. That's why it's so important to be looking at not only the daily, not only the weekly, but also the monthly, as right now the daily is looking sort of mixed, the weekly is looking more bearish than not, but the monthly is telling us that we are getting ready to enter into a long uptrend. Now, if we turn off these moving averages, though, it's very important we pay attention to also with our drawing tools here. Gets a little crazy, obviously, with the Fibonacci's and everything, so just try to kind of zoom all that out and look at our top back here in 1986, and then time cycle analysis told us our next top was in 2001. The following top, based on that same time cycle analysis, gave us our top almost to the T in 2017, and that tells us our next top is going to be in the future in 2032. So is it possible that the dollar tops out in 2032 and potentially puts in a higher high than this, regardless of if it's higher or higher than the previous two right here? Yes, it looks very likely based on these data points and how correct this was. Based off our initial 2 data points, this predicted our third, and now we have a 4th data point. If this one lines up as well, it's going to just further reinforce that this time cycle analysis is accurate. And then we'll notice the blue lines here are the bottom. So we have our initial bottom right here. We have our second bottom here. And then it's predicting our third bottom in the dollar will actually be in 2024. So what happens between now and 2024 is what we're not sure about. This could very easily move back up here, put in a lower high than the top back here, and then come back down and put in a lower low than either of these 2 lows right here. And that would give us, once again, a low, and then a low again based on the time cycle analysis before we ever get this high out here in 2032. But we don't know. Obviously, we only have limited amounts of data points based on the monthly. But again, that's what I'm paying attention to. I would expect, obviously it's happened in the past at least a couple times, so it's worth paying attention to into the future, although it's not going to be like the 100% determining factor based on everything happening. So, and we'll see also on the daily time frame, we can sort of look at the patterns we were paying attention to. Our inverted head and shoulders with a slanted neckline, we were able to consolidate quite a bit break above that neckline, and then we broke down from it out of this small little ascending channel. We're now trying to make our way back up into that zone. And then here we have the red rounding bottom right here. That would be our Eve. And then we have the sharp blue pointy bottom right here. That would be our Adam. And then based on the Adam and Eve pattern, we have our yellow resistance line right here, which again, we got rejected off very clearly. And now we're going to attempt to try to get back up to that area. And then we'll look at, once again, if we broaden it out one more time, we can see our Fibonacci levels. And let me switch once again to a longer time frame. And I'm going to turn off the oscillators here. So if we switch out to a longer time frame here, we notice that our red Fibonacci goes all the way back to the beginning of the chart. The white Fibonacci goes from our bottom right here up to our peak top right here. It's tough to tell, obviously, because I have the yellow line over top of it, but that was like our spike up. Oh, I'm sorry. Actually, this was the one that we did the prediction of where it would potentially top out at. There's a long video on how I came up with this prediction and why I'm using it. But obviously, this is saying that our top would actually be up here, but it's not actually confirmed at this point in time. So you have to go back and look at that longer one. It's very complicated and still theoretical, but at this point in time, so just ignore the white one and pay attention to the red one. We'll notice from the bottom right here, we consolidated at the 236 area. Once we broke through the 236, we shot directly through the 382, the 0.5, and then we topped out almost perfectly at our 618 retracement, which is a 61.8% retracement from the all-time high to the all-time low of this, at which point in time we came down and touched almost perfectly the 382. We bounced back up above the 0.5, acted as support, got rejected once again at the 618 for a double top, came back down again to the 382, and now potentially going to get rejected at the 0.5 or break back up to a new high or come back down to our next key fib level at the 236. So it's important we pay attention to all those things and how they could play out. You know, the market once again is going to do what it wants to do, but obviously if we have, you know, technical analysis telling us that there's a high likelihood of something based on it happening multiple times in the past, you know, it gives us obviously an accurate way to predict what potentially could happen and position ourselves accordingly. But once again, like I always say, it is very important to not just presume with certainty that one of two situations is going to happen or one of infinite situations is going to happen, because in the end, the market will do what it wants to do. And we can't predict exactly what's going to happen because of politics, because of fundamentals, whatever. So next we will jump into our traditional assets. Let's do our Dow Jones here. You know, very clearly we were operating inside of our sideways channel here. Let's turn off our moving averages for a moment. Very clearly operating with that sideways channel. You know, we had broken down from it a couple times, but gotten back inside of it. We broke out from it and then came back inside of it. And then again, we broke out from it. And now we have retested the top of it a couple times. Got a fairly bearish candle today and essentially just closed back at it. Now we'll have to see with that close, are we going to just open back up inside of it and then get rejected, or is it going to act as support and then we continue to the upside? So that's what we're paying attention to. It is important that we're noticing that we do have some clear divergence, some bearish divergence taking place on the daily. If we switch over to our weekly as well, we'll notice once again that we have some clear weakness in the weekly chart as we have a high back here. And then we have essentially what amounts to a lower high here while we put in a higher high in price action. We have all red histograms on the weekly, and we're now confirming below our slope line of the TJD TDMACD, telling us that this slope is potentially, or this trend is potentially rolling over. And then if we just go back to our daily and look at our moving averages, we'll see we broke down below the 21 right here. If we consolidate long enough below this, they'll cross, and then we'll end up starting to retest some of these lower levels. It's not a death sentence to the market by any means, but the last time we had the 821 cross, it was followed by immediate, like, you know, pretty heavy sell-off from the cross taking place right here to the low. From the cross taking place right here to the low. We got like, you know, a nice little 3-4% pullback. But essentially for how long we've been consolidating in this range, we don't want to see this breakout now fail and come back down inside of it, as it's going to tell us that the market is not able to sustain at these key levels. So next we have the S&P, SPY I'm looking at right here. Again, this one is very important because, you know, without taking like the whole big look of everything, we have this very clear support line here in blue that was acting as support back in 2020 was our initial touch. Then we had our next one in September. This was May of 2020, September. Then we had another touch in October. We were able to deviate away from it and continue to the upside. We then had another touch in March of 2021, immediately again in March again of 2021, and then we came down to it again May of 2021, and then a second time in May of 2021, and then we broke down from it here in June 2021, and now we broke down from it again in July of 2021. So we'll see each time we're touching this level, at first we're getting like decent pushes away from it, and now we're just slowly tightening into it. So you can almost draw like sort of a resistance at the top of the range right here that we're unable to sort of get above. And depending how you look at this resistance, you know, you could say basically something like this, where we had a resistance here from the top, kind of peaked above it, but it was unsustainable, throw over, acted as resistance, we consolidated out long enough and then failed to get above it. And then we finally got above it, couldn't maintain it, broke down from it. And now here we're just squeezed into this tiny little range, and it's getting smaller and smaller and smaller. And now here we have broken down from it, tried to get back inside of it again, opened up, and then got rejected and gapped down. So this to me, once again, looks like it's very likely getting near. I mean, obviously it has to make a decision soon because this can't continue on, but it looks like we're getting very, very near to a breakdown from this area. We also have, once again, some very clear bearish divergence. We have a top back here. We have a top right here, which is higher on price action, and then a third potential top here that's higher on price action. But we have a high here, a lower high here, and then a third lower high here. So we have triple bearish divergence on the daily. And then once again, if we flip over to our weekly as well, we can see, you know, we are showing some serious weakness on our weekly chart. We have much more red histograms than green histograms of late. And now we are just basically at that blue support line. If we break down from this now, it's going to flip over red very soon as we lose the slope on the TJD, TDMACD. And again, this is looking very weak at the top of the range here. We are still inside the bullish control zone. We have been inside the bullish control zone for some time. But, you know, we basically have just gotten across back to the upside. A lot of mixed signals here at the top of the range. But again, we have a high here, we have a lower high here, and potentially a third lower high here on the weekly, which again would be like triple weekly bearish divergence. So definitely some warning signs coming on our indexes. And, you know, it's become very clear. It's obviously, we've been expecting for some time, you know, that there's a potential decent sell-off coming based on the technicals. But, you know, when we look at the individual stocks compared to the indexes, we notice that the majority of the individual stocks, the breadth of the market is very weak right now. And for the index to be making, you know, essentially all-time highs or consolidating at what amounts to all-time highs, but many, many, many of the individual stocks that make it up nowhere near their all-time highs, we can tell that there's basically a divergence between the actual market itself and what the index is telling us. So we have the IXIC, NASDAQ basically breaking back up to new all-time highs. This went into a much longer consolidation pattern. We finally broke through the resistance on the consolidation, came back down, retested it as support, pushed all the way back up to the top of the range. So again, this is the most bullish of our indexes. But again, we're seeing some bearish divergence start to develop. We do still have a measured move breakout of the ascending triangle to the top up here at 15,700, and still looks likely to happen. But obviously most of the indexes are going to operate fairly close together, not just because they have a lot of the same stocks in them, but just because the market tends to move in tandem, you know, just cyclically, like some things are going to be stronger than others as there's limited amount of money and it just transfers between the different stocks inside the market. So now here we have the Russell. Obviously the Russell is the weakest or least bullish of all the indexes we're looking at here. The Russell basically entered into a channel back in January 2021, and it has just chopped sideways for what amounts to, like, you know, 7-8 months at this point in time. It has a very clear resistance up here, very clear support here, and then obvious interactions with the heart line in green along the way. The previous time when we came up here, we got rejected by this heart line, and now it looks like we're coming back down to retest the bottom of the range. More often than not, when you get a break of a channel like this, what will happen is you'll come from the top to the bottom, you'll come back to the heart line, get rejected, and then you'll come back to the bottom, and then you will get a break. Very rarely do you come all the way from the top of the range to the bottom of the range and then get a break. You almost always come from the top to the bottom to the middle and then break out the bottom, or vice versa. You'll come from the top to like the middle, you know, or back to the top again, you know, retest the middle, and then you will get a breakout. As like essentially, like this could have been a key breakout scenario right here. When we come from the bottom, go up to the top, retest and the Heartline X is support, and then we come back up to the top, that was our best chance for a breakout. The same way that this is going to be our best or most likely chance of a breakdown. So, but obviously you guys know I'm bearish overall on the Russell. And then if we switch over to our weekly, again, we'll see this is extremely, extremely weak now. The Russell is definitely like the canary in the coal mine, as it's composed of just a bunch of shit stocks. And majority of them at this point in time are not profitable. We have the hard sell signal essentially at the top here. We have broke down from the bullish control zone. We have a bunch of red histograms, almost no green histograms. And now we have actually flipped over the slope line from blue to red for the first time in, this was our CVD dump right here. This was the last time it flipped over red, was February of 2020, right before the capitulation move, right around basically when I was calling that these markets were getting ready to roll over and die. And then immediately afterwards, obviously we break down and see that move take place. So again, does not mean that we have to have some massive capitulation move, but more than likely it's telling us that we're getting ready to have a substantial sell-off. The time before that, when this took place, was back in 2018 in September, and that the Russell told us, this move was coming, and we got essentially over a 26% pullback. And then this one here, the Russell told us something was coming, and we got a 42% pullback. So, on average, I would say we're probably going to get, if this, plays out how it has in the past, based on technical analysis, it's not unrealistic to think we would get something around, a 20% to 40% pullback. So that's what I'm paying attention to. Again, the other markets are much stronger, but showing some key divergence on like weekly charts. But when we look at like the monthlies, look at some of the moving averages, and we get an overall idea, as what we've been talking about for a long time, about this musical chairs game going on, where there's a limited amount of money chasing winners, and then everything else is just kind of like getting dragged along with them. So let's look at some of our sectors in the market, and then I'll jump over in the comments section. Appreciate everybody for tuning in today. If you're just tuning in, remember this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. We have XLB, material sector, was operating inside of a descending channel, got a breakout, nearly hit our measure move to the upside, and then we saw a very bearish candle, tried to recoup that area, and then it got rejected again. It looks like this move is probably not going to play out. I would expect it to come back down here and find support at the top of the channel. If we can consolidate long enough, it's possible we get the move back up and the measure move to play out. But at this point in time, this is not looking great. And obviously, this is our materials. XLC communication, again, got a new high here in the last few days, but have been fairly bearish price action since then. Trying to save this 821 from crossing to the downside. But overall, starting to see once again bearish divergence showing up on our various indicator oscillators as we put in a high here, higher high on price action, high here, and lower high on our indicator oscillators. Once again, a bunch of red histograms in a row, and we're below the slope line, getting ready to lose the 821. Not looking good communication. XLE, energy sector, obviously we got our nice little measure move breakout back here, but again, we put in a high, failed at that level, came down here, essentially are getting rejected and coming back down to key levels. While I'm bullish on this in the long term based on like the monthly chart and our moving averages and everything, this is a key underperformer in comparison to like everything else in the stock market. 95% of what's in the stock market now is making all-time highs, and obviously energy is not. So this is a very, very key underperformer. And while we're seeing some bullish signs here on like the daily chart, we're getting rejected at key levels. And again, this is a key underperformer as we're not able to get back above what was key support back here at like these 2019 levels is now acting as key resistance. So, and again, a lot of this is going to depend on oil. Also, I think that a lot of this got ahead of itself just because like everybody was pushing for all this like renewable energy, and it's just not realistic at this point in time. We're still years away from functional renewable energy. And if you don't believe me, look at Germany. They built massive solar farms and all this stuff, and now what are they doing? They're about to be relying on a pipeline for oil from Russia. So how did all this solar energy work out? How did all this renewable energy work out? Well, obviously not that well if all of a sudden they need oil again badly. And then if you don't believe me about it working out well because you care about the environment and you don't care about anything else, well, ask the German people how they feel about their energy prices right now. And how much their energy prices went up when they switched over to solar, as it's extremely expensive to like maintain. It's extremely expensive to actually build, and it's net probably negative on the environment because it contains not only a ton of manufacturing to build these panels, a ton of upkeep to keep up all this like solar energy and clean energy, and not to mention the amount of actual like coal that's burnt to actually like withdraw all these metals from the earth and then process them into the parts that build all these panels. So it is what it is. It's nice on paper, all this clean energy and the future, and we care about the earth, but in all reality, it's just not viable right now. And I think Germany has more than proved that. XLF, financial sector, extremely weak. It's made its all-time high back here in June, and has been unable to get back up towards those levels again. We're barely hanging on to the 8 and 21. And if we look at a little bit longer of a time frame, flip over to the weekly here, you'll see we're barely just hanging on to the 8 moving average, and the 8 and 21 are starting to converge. They were diverging throughout this range. As they got further and further apart from each other, the gap in between them got bigger and bigger, and then we had that heavy sell-off. We've been unable to basically get back above those levels, and now they're converging. If we just stay around this area long enough, the 8 and 21 will come closer and closer together, and then more than likely what will happen is we'll break down from that level. It's obviously still possible we consolidate here and then break to the upside, but we have left the bullish control zone, which we were operating in for basically like the entire year. We're now outside of the bullish control zone. We've had only red histograms for the last however many weeks this is, couple months, and now we're below the blue slope line. So again, financial sector is telling us not good. We're losing momentum, losing strength, and more than likely going to be at least retracing temporarily. XLI, industrial sector, similar situation. If we look at the broader picture here, just going back from the CVD dump in March, we have this single channel right here. We've been operating inside of the top of the channel. Obviously the yellow line has been acting as resistance. Our dotted green ascending line has been acting as support along the way. We're basically chopping sideways. If we chop sideways long enough, we're going to be retesting that support. We are starting to see some clear resistance, but could this be a bullish reset and we continue to the upside? It very much could. But when we zoom out and look at the big picture here, and now you'll notice we have another ascending channel taking place with a support in blue and resistance in blue, and once again an ascending heart line. This one goes back to 2009. From our low down here in 2009, we have clear resistance, support, 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 support here, support through this area, and then we broke down through it in our dump right here, came back up, it acted as resistance, we broke above it, acted as support, and now here we are damn near at the top of this channel. So if we've been operating inside this channel since 2009, here we are in 2021. So for the last 12 years, we've been operating inside of this channel. So what's more than likely going to happen? We're going to continue operating inside this channel. Obviously if it's been operating in the channel for since 2012, or for 12 years rather, I would expect it to continue operating inside the channel. So more than likely, we have very limited upside potential here, and then we have much more downside potential. So while we could easily break out of the top of this channel and break through this 12-year, resistance, we have a potential 18% move to the upside, but we have a potential to the downside. If we retest the heart line, about 13%. If we come down and retest support, 33%. So I don't like those odds. We're much clearer to the top, to the resistance, than we are to the support. So we could easily get 18% to the upside. We could easily get 33% to the downside. So if we look at that as a risk-reward ratio, that tells us we don't want anything to do with this right now to the upside. Because obviously the difference between the move to the upside and the move to the downside, we see a much larger red area, a much smaller green area. And then if we look at that as a risk-reward ratio percentage, we have a 0.52. We want that to be opposite. There's twice as much downside potential as there is upside potential based on a 0.5. We want it to be a 2.0 or higher. I personally do. That's my trading strategy. That's how I measure risk reward. I want to have twice as much upside potential as downside potential. And the idea behind that being, if we flip a coin and every time you win the coin flip, you get $1 from me. And every time I win the coin flip, I get $2 from you. That's a 2-to-1 risk reward ratio. So we can flip that coin 100 times. Chances are, it's going to go heads 50 times and tails 50 times. So if you're heads every time and I'm tails every time and we each win 50 times, the same amount, but I get $2 every time I win, I end up net positive. And that's the idea behind using a simple risk-reward ratio based on resistance and support. So that's why in this situation, this would be the opposite. You're heads every time, I'm tails every time, but I pay you $2 every time and you pay me $1 every time. That's a 0.5 risk-reward ratio for me because I'm actually paying out more. So the likelihood of me losing money if I take this trade 100 times is twice as much as me succeeding. So I'm not interested in that. Even if they have an equal opportunity like of playing out, the risk reward itself makes that a no-go for me. And that's why it's so important to piece all these things together. All the technical analysis in the world is great, but if you don't actually use risk reward ratios, if you don't use position sizing, you're never going to last in these markets. And that's why it's so important to piece all these things together. Use your technicals, use your risk reward ratio, and use your position size management, and put that all together. Get a trading plan, keep a trading journal, do it, all these things successful over time, and you will be a winner because the technical analysis is your edge on the market. The risk reward ratio gives you another edge on the market because you're only taking trades that have a high likelihood of paying off if they succeed, even if it's a 50% chance that they succeed. And then finally, position sizing ensures that no matter what happens in the market, you don't just get blown out because you went all in on 5 trades and got unlucky. It's going to give you the opportunity to make that 100 trades so that the odds can actually play out in your favor. If you sat down at a roulette table and roulette went black or red every time, and it's 50% every time statistically, say there's no green, let's say. So it's 50% red, 50% black after 100 spins. But there's a possibility you sit down at the table, you have $100, and you put $10 on each bet, and you bet on red every time. It's possible it just goes black 10 times in a row and you lose. But the likelihood of it going black 100 times in a row is extremely unlikely. And if you look at the little ticket that prints off at the end of the night on a roulette table, if there was 1,000 spins within a couple percent standard deviation, it's going to be 500 red, 500 black. Again, ignoring the green option. So that's why it's so important to piece all these things together and use them to your advantage. If you're missing any one of these key principles in your trade strategy, or you're not giving yourself accountability by keeping a trade journal, eventually you're going to fail over time because you're not appropriately doing every step that you need to do to piece this all together. If you do all those things correctly, the likelihood of you succeeding in the markets is exponentially more beneficial than if you've just mastered technical analysis, just mastered, risk reward, or just mastered position sizing. Put it all together and you have a massive edge on the market, and you will exponentially do better than someone that is missing one of those key components. Again, not financial advice. XLK, technology sector, at all-time highs. Very strong in comparison to everything else. Seeing some clear bearish divergence on the daily here. Do need to be careful on this, but if you made me pick something, if I had to invest in something right now at these levels, it would probably be technology or, well, we'll see in a second, but there's only a couple things that are looking this good. We have consumer staples next, XLP, again, operating inside of a very similar channel for some time now. This is on the daily, but we basically entered into this range back in April of 2021. Very clear resistance, very clear support at the bottom of the channel. And then obviously, we can see the heart line is substantial as well. Here we looked like we were going to break out to the upside, got rejected, and now we see a very bearish candle coming in on consumer staples. That is not good. What does that mean? It means this is, basically a blend of cheap and expensive goods that consumers purchase. So if it's cheap things and it's expensive things, it's not like necessities necessarily. It's just stuff that people, consumers, that, we're spending our money on. So if all of a sudden this starts to show weakness, it tells us, hang on, something's wrong that's affecting everyone that's a consumer. And in a world that essentially does nothing but consume, exponentially more than they produce, or at least the United States anyway, that's not what we want to see happening. So definitely seeing some weakness right here. What do we expect to happen? Come back down, retest like the 70 level. If not, back down to like 68, the bottom of the channel. But again, the more likely thing to happen is we'll continue to operate inside of this channel until the one time we break. But we do see some very, very clear bearish divergence on the daily, as we had like a top through this area right here, and then we have a what amounts to, it's looking like it's going to be a top through this area, but we're obviously higher now than we were when we put in the stop back here. So let's switch over to real estate next, XLRE. And again, obviously it's no surprise to anyone that real estate is, you know, at all-time highs and probably one of the best looking charts. Again, sector wise, you know, this is the best looking technical chart. Do I want to just go out and buy a bunch of real estate right now? Not necessarily, you know, but if you factor in extremely low rates, even if prices are, you know, high, as long as you're getting a good value on something, if you get extremely low rates, it's not necessarily a bad time to be buying real estate right now. But if you're in an area where, you know, real estate is up 100% over the last year, or 200% or 300%, you know, no matter how low rates are, it's still not going to be a good opportunity, because the likelihood of that play playing out for you is very unlikely. But if you're in an area where, you know, it's a nice area, prices aren't going up crazy, and you can get an extremely low rate, maybe not a bad chance to buy or opportunity. But again, overall much stronger than the majority of the charts. But again, we see a high here, we see a higher high here, we see a high here, we see much lower high here. We are down below the slope line. It is still blue, but we have a very clear rejection at that slope line. And typically when this happens, when you get a break above it, come down, it flips over red, you come back up, it gets rejected, and then you see this diverging. This is still blue, but we're very clearly below it. That's usually a very, very bad sign. It's like divergence between the actual slope and the actual like histogram, and usually that leads in like a capitulation move. So I think more likely than not, this gets a heavy sell-off sometime in the near future. But real estate's obviously lagging of like the overall stock market in general. Next we have XLU, utilities. Again, big time underperformer, you know, compared to the markets. Obviously, you know, operating inside of this channel going back to 2009, very similar to some of the other charts. And we can see we operated inside this channel almost perfectly. Even with our little breakout here, we were able to regain those levels. But now we're just basically dragging along the bottom, and we've been unable to get back above that 2020 February high. So while the majority of other markets, the majority of other sectors are making new all-time highs, we're still a range off. Now, we're not way off of the all-time high, but the fact that everything is strong right now, or at least has been over the last year, and almost everything is making all-time highs, but energy and utilities are not, that tells us that these are serious underperformers. So while this is more of a safety play, a risk-off type play, you know, it makes sense fundamentally or technically, but, you know, this is not going to be the best place to put your money if the stock market's going to continue what it's been doing, or if overall asset prices are going to continue doing what they've been doing. This is probably the last place you want to be. But if you're looking for safety all of a sudden, and you're looking for, you know, more comfortable levels to invest in something, this is why people will run to this, as it's not just at some blowout evaluation or all-time high or whatever. So overall weak, but again, this is typically a safety play in the same way that like dollars or bonds would be a safety play in extreme moments of like volatility. Although obviously this would not have done great for you, as you know, when it capitulated, it went from 70 down to 43. So again, not necessarily the safest, but typically a safety play. XRT, so retail in general, overall bullish pattern, an ascending triangle, you know, a basically like flat resistance at the top of the range, and slowly just putting in higher lows. But now here, just like we said, this looks very weak. I also think, like, you know, the whole reopening trade and everything, I really just don't see retail all of a sudden having this massive amount of spending. And as the stimulus starts to fall off and we see very clear bearish divergence taking place on this chart, I don't think all of a sudden people are just going to get, you know, all these inflows that we're going to be able to break this out from our previous high back in January. So if we've just been chopping sideways for the last 7 months and we see all these like stimulus or like crutch programs ending, all of a sudden people are going to have to pay student loans again. Maybe one day again they'll have to pay their mortgages or their rent. You know, we're seeing pandemic unemployment assistance come off. We're seeing less and less people theoretically with new unemployment claims and actually going back to work and working again. Theoretically, all that fundamentally or technically tells us it's probably not going to be breaking out to the upside. Now, is there a possibility that all of a sudden we go into like, Delta lockdowns and everything starts crashing down again, and then the government starts just dumping trillions of dollars back to the people, and the Treasury just says F it, or the Federal Reserve just says F it, and just starts dropping money in people's accounts left and right? Is that a possibility? Yes. If that does happen, do I think this would break out to the upside? Yeah, probably. As you give people money and they're probably going to spend it on dumb shit because that's what we're good at. So while I don't think that this is going to be moving to the upside, there's definitely an argument to be made that it could be. But right now, it does not look good. XLV, healthcare, by far the strongest sector, in my opinion. If I had to pick one place to put money right now, this is where it would be. Even though we're at ridiculous valuations, look at the narrative right now. We're going to need a third jab soon. All these people have been putting off all this stuff while they were too scared to go to the hospital, or things were closed down, or whatever the situation is. Eventually, there's all this pent-up demand, and people are going to have to go out and get this stuff done because a lot of them are necessities. Maybe we'll get, a new equivalence of like Obamacare or something like that, and all of a sudden people will be able to get things taken care of. I don't know what the situation is going to be, but I know what this chart is telling me. It's by far the best scenario. Now, I don't want to say afraid of, or what I'm very clearly paying attention to, is this looks extremely toppy to me, because if we take our last swing high right here back from January, and then our sell-off, which it wasn't a substantial sell-off, but it was notably, 7.5%. We can call that our initial swing high, and then our swing low right here, obviously. And then if we draw our Fibonacci from the high to our low, and then we use our Fibonacci extension targets, we see very clearly that this level right here, the 1.618, was acting as resistance very clearly. And then that was when we finally broke through that resistance, we started moving up. And now where are we at now? That's obviously a very key level I pay attention to. It's 100% of the previous move plus another 61.8% on the top of that move. So 100% takes you right back to the level we were already at. Another 61.8% on top of that takes us to this level. So that was obviously I'm not the only one looking at that, clearly. The entire market was looking at that as resistance and a key area to sell into. Once we broke through that, the next area I'd like to pay attention to is the 2.618. So we will see now that this is the initial move back up plus another 1.618 on top of that, which would take us up essentially to exactly where we're at right now, $135. So you could say that we already hit that target, that red box area, which is our target to the upside, at which point in time now we would expect a retrace back to test some of these key levels. Maybe we'll just continue to the upside and we'll see this thing go up to the 3.618 next. I don't know. We'll have to wait and see. That would be at $145. But this looks like a very key area where we'd at least consolidate, get a short-term pullback, or possibly be topping out. But again, healthcare, probably the best sector in my opinion, based on technicals. Shit, and fundamentals at this point in time. Especially, hey, make it mandatory. Now all of a sudden everybody's got to get one. Now we're jacking up the prices. So, who knows what's going to happen. XLY, consumer discretionary. By the way, I do not think that they should make it mandatory, nor would I ever endorse that. I'm just saying, who knows what's going to actually happen. So XLY, consumer discretionary. Again, not necessarily going to be things that people want to buy. This is expensive things, cheap things, all kinds of different things. But we had a very clear resistance here. We broke out from that resistance, couldn't maintain those levels, jumped back up to a new all-time high, and now here we are retesting that same area as support. So what we want to pay attention to is this support able to hold right here at this key level, or are we going to break down from this? If we do, it's going to look like a double top, and then I would expect us to come back down to some of these key levels, probably 200 exponential and simple moving average. Very clearly, once again on the daily, some bearish divergence. If we switch over to the weekly, we'll see that as well. So XTN, transportation. I didn't actually realize, nor did I intentionally not look at the transportation ETF and then look at all the individual transportation stocks recently. I must have just accidentally clicked this close or something, because I typically would look at transportation as a whole and then look at the individual ones. But we were very clearly operating inside of this channel going back to 2020, that same channel basically. This was a little weaker as we were operating in the bottom portion of the channel, but when you consider what was taking place, it makes sense. We only had one real time when we got to the top of the channel, but we operated inside the bottom the majority of the time, but we did make it up to new highs. So, which obviously, we had a lot of transportation based things, rental car situations. We had, you know, airports shut down, less flights, et cetera, et cetera. So you would expect this to be weaker than most sectors, you know, in the market. But here we have broken out of that area, and now I would expect us to eventually come down to one of these key Fibonacci levels, or possibly our measured move of the channel break. But since we broke down from it, we've basically just been kind of floating down to sideways, while our indicator oscillator floated up. So that is essentially what I call a bearish reset. So, you know, we were moving to the upside. We have now sold off down while the indicator floats up. So now when the time is right and this indicator is back inside like the top of the range, if all of a sudden we start pushing to the downside, we have the whole entire range to sell off. As where if this thing just kept going down while price action went down, eventually we would expect it to be like in the oversold or low areas and then bounce, and then price action could correspond with that and push to the upside. But that's not what we're seeing. We're seeing what amounts to a bearish reset, in my opinion. And then if we just look at a couple individuals, this is the JETS ETF, you know, very weak, obviously, breaking down below 200 exponential and simple, flat slope. This looks like it's going into a long-term downtrend. Hail, rental car ETF, again, barely hanging on to the 200 exponential and simple, below the 200 simple now, and it looks like these are rolling over, getting ready to go into a long-term downtrend. And we'll see they went into a long-term uptrend back here in May, which was at $27, and now here we topped out at 72. Here we are at 57, and it looks like we're going into a long-term downtrend. So that's why I like to trade the slope of the 200 exponential and simple moving average and the direction of the 200 exponential and simple moving average, because you would know that the majority of your trades should be to the upside, and then you should be buying dips, as opposed to if this is slope to the downside, we should be taking the majority of our trades to the downside, and we should be selling rips. Hence the term, buy the dip, sell the rip. You don't want to just buy the dip in a downtrend because the dip keeps dipping. You don't want to just sell the rip in an uptrend and then, sell the rip in an uptrend and then hold your short because you're probably going to go back up. UPS here, again, looking like a very clear double top. You know, even though the earnings were decent on this, you know, it was already priced in, obviously, because it sold off. And then also the lack of actual like demand or lack of packages, you know, is what scared the market here. Now, are we just coming back down to fill this gap and touch a 200 exponential and simple? Definitely a possibility. We'll know when we get there, you know, and potentially be a buying area. But right now, does not look good to me. FedEx, same situation. Demand is falling off. You know, put in a higher high, but barely over that previous high right here. So, you know, where are we at right now? Well, we're back at our 2020 October areas. So we basically have wiped out the entire year gains. We're here consolidating at the 200 exponential and simple, potentially getting ready to roll those over and break down. U.S. oil, not even close to a new all-time high. We're at like 50% of our previous all-time high. But here we are essentially at the top of the range, put in a cycle high right here after our ascending triangle breakout, got our measure move to the upside, retested that breakout for support, came back up, put in another, a lower high rather, from this previous high right here. And that tells us that this is probably going to be rolling back over. And if we cannot maintain this level right here, going to be selling off down to these key moving averages. So, and again, that makes sense if you have less planes flying, if you have less people driving, if you have potential lockdowns happening again, if you have less packages being delivered, if you have overall, you know, less freight ships going across the ocean, we're going to need less fuel, less oil. Therefore, you know, you would expect, obviously, slowdown in economy or GDP to essentially be a lower cost of oil, as there would be less demand for it, assuming supply stays the same. Does that have to happen? No, but it sure looks like it's potentially going to be happening. And again, the you know, transportation sector is like canary in the coal mine. And then here, just taking another quick glance, nothing has changed on this. This is our M1 velocity of money. Again, we sold off violently from our 5.22 velocity, and then we're down here now at like the 1.19 velocity. So obviously money is at, you know, money velocity is at all-time low levels. So what that tells us is, and why it's so important is, it tells us that no matter how much money they pump into the system, the money is not moving the same way that it used to. So regardless of how much money there is, how much M1 money there is, how much M2 money there is, the velocity of these measures is way, way low at historically low levels, which means that it's not getting spent around into the economy the same way. So let's take a little break there. When we get back, I will jump in the chat and say what's up to everybody, and then we can continue on with our next set of technical analysis. So I'll just take a quick couple minutes and I'll be right back after I get a drink and use the restroom. All right. What's going on, guys? Make sure you like and subscribe. See, the likes are lacking right now. I'm sure it's the same crew, though. You guys are probably all subscribed. What's going on, Spike? Good to see you, my man. Shazam, let's go. That's right. Let's go. Our kid's in the house. What's up, brother? Good to see you, my man. CW, what's up, brother? Thanks, good sir, for sharing your thoughts as you do. Of course, my man. I do this for you guys. I also enjoy it as well. Like getting on here, running through everything. And a lot of times, you know, I'm just firing from the hip, so I might see something that I did not notice otherwise. How much further do I think TLT can run? I mean, man, that's a tough question. I mean, could it run higher? Let's jump back at the chart really quick and then we'll keep moving. Um, I mean, realistically, it should top out, in my opinion, at the point, assuming it has not topped out already, which I've noticed there's definitely like some options plays here that are starting to look like it potentially could have topped out. I don't think it has, though. I think it's going to run up to like 140, 154, the 0.5, or potentially, I think there's a high likelihood it could run up to 160. And the reason I say 160 is when we zoom out and we really look at this chart and keep in mind, you know, this is going back to like 2000 back here, 2002. But we have this channel basically with the blue support and resistance with the green dotted heart line, and the top of the channel lines up basically with the 1.618. So that would be like $160. Which again, you know, we're in a pretty powerful uptrend here. We're inside the bullish control zone. So there's definitely a possibility we at least hit the point. I think it's very likely we hit the 0.5, if not the 618. At that point in time though, you know, you guys know how I feel about channels. More than likely, this channel has been operating as resistance or support throughout this entire phase. Now, obviously, also you'll notice I have like this green parabola drawn in as well. You know, that if we switch to the monthly time frame, gives us a little more clear of a picture, but that was acting as support through here, and then potentially would eventually act as support here. But it doesn't mean that we can't get essentially what amounts to, what do I want? Oh, what? No, I was about to draw. What we could easily get, what amounts to something like this happens, it comes up to the 0.5, consolidates, shoots up to the 0.618, and then after that, we see it start breaking down, you know, back down to like this level here. Something like that is what I think is most likely going to happen. I don't think we've topped out yet, especially with like, you know, obviously with what's going on around the world right now, especially here in the United States, we got like record cases and it's like, oh no, the Delta, oh, everyone be afraid. You know, so I think realistically, we would probably run up slightly higher. And then again, we'll have to see what happens with like traditional markets, what happens with the dollar. All these things like kind of are like the different levers that interact with each other. But I think more likely than that, we get a situation, something like that plays out. But, you know, that could change. And if it does, you know, I'm here every couple days to let you know. Or obviously for group members, I'm always around. So you're going to know as soon as I get a different idea. But that's the beauty of looking at like a weekly or monthly chart. Probably nothing serious is going to change like overnight. You know what I mean? All right, so let's keep moving here. Yeah, so we did our traditionals already. Let's go over, let's look at like our tech plus, tech and friends. They have a couple pretty nice movers here. Again, I hear the Tesla crowd getting extremely bullish. Oh, this is it. We're getting ready to break out to the upside. We're going to a gazillion dollars. Tesla is where it was at in December. So it has literally gone sideways for this entire year. And we have a high, we have a lower high, and we have what amounts to potentially a third lower high. So this to me looks like a giant descending triangle. Oh my God, what happened? Let's turn those back. I need to just delete this. Yeah, right? No, I'm gonna, well, fuck it. I don't need that. Yeah, this amounts to just a giant descending triangle to me. We have a high right here. We have a clear low right here. We have another high right there. And then essentially have what amounts to a low right here. So did we break out of that descending triangle? Yes, technically we broke out of that descending triangle. But something that happens like very, very often is you'll get this breakout right here. And that's it's essentially a throw over. Everybody's looking at this clear resistance right here. We get the break and everybody goes, this is it. Buys the breakout. And all they did was provide liquidity for the people that are already in this. Because the key that what really actually has to happen, you know, a triangle's great. Oh, that's awesome. We broke out of a triangle. Good for us. But what really has to happen is we have to take out this previous high. So until we get above this high right here, breaking out of this triangle means nothing. So that's our next key resistance we're paying attention to is like $780. If we move up there and start closing, then obviously we're looking at the previous all-time high, and then after that, new all-time highs. But when we look at the momentum on longer time frames, and we look at what's happening on like this weekly right here, well, that looks to me, we lost our 821 cross right here. We saved the 821 cross right here. We started losing again, and then somebody stepped in and tried to pump this back up because they don't want it to roll over and die. I mean, I don't know who it was. Maybe it was Cathie Wood. Maybe it was Elon Musk. Who knows? But somebody doesn't want this to roll over and die and push the price back up. So we have to see now what happens. How does this actually react? Is there legitimately market, like buyers coming in at this level? Or is this just a reaction like breakout rally of the descending triangle? This is overall a bearish pattern, but you know, it has broken out to the upside, which there's still like, you know, over a 30% chance a bearish pattern is going to break out to the upside. So if we see some continuation, I could get bullish on Tesla again. What I want to see is I want to see the breakout come back down and retest the breakout area, and then see that area hold as support and then continuation. But to me, this looks like essentially like a short squeeze, or, you know, a throw over. And again, we have a rejection candle right here, which is not terribly bearish. Then we have a fairly bearish, like gap up, sell back off. And then now we have a third day bearish in a row. You know, this is basically a full on like shooting star. So we now have 3 bearish candles in a row on what amounts to a gap up, which typically leads to, you know, this very likely could turn into like an island reversal where we either gap down or we just start selling back down heavy. I would expect probably we'll be at $688 very, very soon on Tesla. You know, but again, the cult is in full effect again. I hear everybody talking about new all-time highs. They're talking about 2,000, 5,000, 10,000. Airbnb on the daily. You know, there's still potential here. The 821 is crossing to the upside. I still think this thing's coming back down. What I want to see is, does the higher low hold? We're starting to see a little momentum. We're finding some support right here. We're seeing some, you know, what amounts to some positive price action, nice little slope action, potentially about to enter into the bullish control zone. This could be a nice little, you know, scalp to the upside for sure. And obviously that's why we have it there. I did not take a stab at that yet, though, full disclosure. And if you're just coming back or new to the channel, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Uber is next. You know, Uber obviously, you know, basically got our little open back here in May 2019. You know, sold off very, very heavy to the downside, came all the way back up. And we'll notice too that from our previous high, this is why these Fibonacci extensions are so important. From our previous high, if we draw in our fib, well, I'm right here. If we draw in our fib basically from the top to the bottom, and again, you're supposed to just put the dot at the bottom right here, but I like to extend it out in the future so I can see what's going to happen. But if we look at from the top to the bottom, our Fibonacci extension target to the upside, the 1.236, is our first extension that I pay attention to. And you'll notice that literally it to the dollar came up here and topped out at the 1.236. So that's why Fibonacci is so important, and obviously Fibonacci extensions as well, because, you know, obviously you wouldn't have known this was the bottom until it happened, but you can see, like in hindsight, very clearly here, and I talk about this all the time, you know, you can see very clearly here, this was a clear swing low, but it also ended up being the 0.5, which we wouldn't have known that until it hits the final low. And then again, we bounce up to the upside, and it's very clearly the 886. Very, very clearly. And then after that, capitulates down. Then we have the swing low. So now we can use it in the future. So when we look back at hindsight, we say, wow, look at that reaction off the 886 before we knew it existed. Look at that reaction off the 0.5 before we knew it existed. Look at that reaction, you know, off the 786 before we knew it existed. So that's why I say when you can identify, and we'll do a quick little one of those videos. Obviously, I already told you. This is like spoiler alert. You already saw the end of the movie. So you know what I'm about to show you here. But we can just start identifying these clear areas of support and resistance. So very clearly, we see these areas of support and resistance taking place. Okay, this was obviously the top right here. This was obviously a bottom. This was the top. This was a bottom. So when we see that all, and then obviously this top here, and then when we take our Fibonacci and we draw it in, and we say, okay, this is our bottom, you know, right here when it bottomed, we can look at that bottom and we can see, if we zoom in on the chart here, you know, were there reactions based on that? Is it likely that was the bottom? Well, yeah, maybe. We see some stuff here. There's like some little reactions here, little rejection here, you know, but it kind of just is in the middle of nowhere. Doesn't quite look right. And then when we come up, we get rejected at the 786. So you're like, yeah, kind of that was the bottom. And then all of a sudden it starts selling off. And you're like, well, where is the bottom going to be? Without knowing, obviously. Now we already know where the bottom is because we're looking at it in hindsight. But when you start looking with this, and let me just make this a little darker. When we start trying to line this up with some of these key levels, what we see, was that likely the bottom? Yeah, maybe. You know, it obviously lines back up with this support level here. It lines back up with that top when we started. But when we start extending it out, and then all of a sudden, you'll notice that the lines will come perfectly in line at a point. So all of a sudden, when we get down here to the bottom, we see now all of a sudden the 0.5 lines up perfectly. The 886 lines up perfectly. Obviously the 1, and then the 1.236 lines up perfectly. So that's what I mean when you're saying you're essentially like predicting out into the future where these fibs are going to be before they actually happen. You know, and again, it's not a real technique in the sense that you're using Fibonacci extensions in the same way, but it can be functional and useful to do. And a lot of times that will correspond with what amounts to a Fibonacci extension from like a low to a high to pick out your target. So the same way we ended up picking this out from the bottom to the low, in order to use the Fibonacci extension tool correctly, we would take our swing low from right here to our swing high right here, and then we would look out and extrapolate that to what our potential Fibonacci extension targets would be. So if we look at the 1.618, we overshot that very clearly. If we look at the 2.618, we undershot that very clearly. So in this case, you know, I would imagine this is probably somewhere around like the maybe 2.236 or something like that. But again, you know, it's more like a theoretical type predicting a top or a bottom and then looking back at it in hindsight. So now we can see very clearly though the reactions along the way, and when this starts to sell off again, we would expect these key Fibonacci levels, after seeing how substantial they were along the entire way, to react in the same way again. So while the traditional sense of what you would do now is take from the bottom to the top here, and that would be our Fibonacci that we're going to pay attention to now, we can leave in place this previous Fibonacci. Let me make that orange so it's not as bright, and then let me make the green slightly brighter. So now when we're selling off here, we have from our low to our high, once we hit the 236, which we hit perfectly on the initial sell-off, we know that we're potentially topped out, and then we would expect a lower high after that. And then you see we get rejected at the 200 exponential and simple, and they're starting to roll over to the downside. So now we want to pay attention to our 382 down here, which is the next key Fibonacci level of the entire move up. But also we want to see how does that correspond with our initial Fibonacci extension targets which we left in place, which this is the 886, which lines up perfectly with the 528, and you'll see the 377 here. So when we start putting all these things together, it gives us a broader picture as opposed to just looking at one thing. We can see how these things are corresponding, because more realistically, we can see our next target to the downside is probably going to be the orange 786 or the green 382, and then the final target, or next, I shouldn't say final, but the next target after that is probably going to be at the 0.5 in green or the 618 in orange. You know, and then obviously depending what happens with price action, we can look at our next one down here, which would be the 0.5 and the 618 reversed, etc., etc. So, but people always ask me like, how do you draw a new chart fresh or whatever? That's just basic couple little Fibonacci's you can slap on. Pinterest next. You know, obviously we have been absolutely nailing Pinterest from the all-time high here. We saw this extremely bearish candle at what amounted to this key resistance, and then sold off, and then we were able to, from the bottom here at a key Fibonacci level, which we'll see that's the green 236 here, from the move all the way up from our bottom here to our top here. And you'll notice this is the exact same thing drawn in right here. I have an orange, the sell-off from the top here to the bottom right here, and then look where we topped out at, almost exactly at the 1.618 in this case. So the last one was at the 1.236, which we'll see there was a clear resistance to the 1.236, and then we gapped up, came back down, retested it, continued up to the 1.5, which is the next key one, and then obviously the 1.618. We were unable to maintain that level, at which point in time we sold off to the 1.236. Oh, nope, just kidding. To the 1.382, bounced back up, could not maintain this level again, saw our bearish candle come in, sold off, and where did we sell off to? Exactly to the 236 of the green move up here. So you see why this is called technical analysis, because without any bias, without even knowing what chart I'm looking at, I just do the same thing over and over again. Like, you know, fundamentals are great. And if I'm going to invest in a company and not trade it and not look at a chart, and I want it to have good fundamentals, I want it to have good devs, a good team, I want it to have good price earnings ratios, I want it to have all these good things so that I can potentially make a good investment. But when I look at technicals, I'm a mechanic. I could literally don't have to know what the ticker is. I don't have to see prices on the right. All I need to see is swing highs and lows. All I need to see is moving averages, and nothing else matters. Price targets don't matter. Actual prices don't matter. None of that matters. The actual asset I'm looking at does not matter. Does it matter if there's good devs? No. I'm looking at this chart specifically and exclusively from a technical standpoint. And that's why technical analysis is so important, because it's reliable. Once you figure out what works, it doesn't matter what I'm looking at. I know what works based on what has worked thousands and tens of thousands and hundreds of thousands and millions of times in the past, when I have looked at countless different assets in countless different markets. Whatever it is I look at, technicals work. So that's why I like to use exclusively technical analysis for trading, but for investing, I'll use some fundamentals. So now here we are, and I'm consistent. You watch these videos every day, you see I look at no matter what asset it is, I do the exact same thing over and over again, and it works. It's a fact. It works. So here we have clear rejection. Here we have clear support, again at those key fib levels. And then once again, a clear rejection. That's when we took profit on our Pinterest trade for 32% gains. Once we broke above this key fib level, we expected a 2 fib level bounce, at which point in time we came back down to the heart line of the channel and also our previous fib level. Once again, put in a lower high, got rejected at the top of the channel, at which point in time, there was a capitulation move after that based on not only Pinterest earnings, but Pinterest is one of the first that has been doing what all these things have been doing. They put in their earnings. The earnings actually aren't bad, or maybe they are shitty, but regardless, there's a massive sell-off gap down. This was probably one of the worst. But why is there a massive gap sell-off? Not necessarily because of the earnings number, not because they didn't meet or beat their earnings. Why? Because they're topping out based on user base or demand or new users or whatever. So what does that tell you? It tells you that we have probably peaked, at least temporarily, for this cycle. It's that canary in the coal mine saying like, whoa, like we have reached peak growth. It has happened and it is done for most of these sectors, possibly for the entire economy. So from that point in time, obviously from when we sold out, if we look at where price action is now and we said, okay, we want to get back in Pinterest because I like it and it's good. We can immediately buy back in and spend the same amount of money and get 25% more shares. Or we can spend 25% less money and just get the same amount of shares. But regardless, we're waiting to see, does it break back above these key levels? Is it going to come back up and try to fill the gap? Is it going to sell off further back down to the channel? Is it going to hit our next target, which would be the green fib? Is it going to hit our next target to the downside, which is our next orange fib right here? We don't know for sure right now. So could we, basically just try to catch a knife right now and buy? Sure, we could. But that's not really technical analysis. That's more just like taking a stab at something. And I would rather take a stab at it when it bottoms at a key level. I would rather see it touch a key level to the bottom or touch a key level to the upside to either buy or sell than to just break through a clear level and then come back up and try to get back to the upside. I don't like that as much. It's much less reliable. So again, we're going to sit on the sideline for this one, wait and see what our indicator oscillators are doing. And it looks like this thing's weakening. So we're probably going to get rejected here and roll over. We could very easily try to come back up and fill that gap. But either way, I'm good for right now. Let's look at Wish next. Again, another one of these ones that has literally just, from where it IPO'd in December to now, it has literally just died. It's just been bleeding out. It had the initial pop to the upside, which keep in mind now that this was probably what Robinhood is doing. Okay. We saw Robinhood have a pathetic move to the upside and then basically just kind of sell off. There's a very high likelihood that it's doing this right now. And it's getting that burst to the upside, but then afterwards it's just going to bleed out over the next few months. Do I wish that I would have bought some Robinhood and scalped it to the upside in hindsight? Yeah, sure. Of course I like to make money, but hindsight trading is the easiest thing to do in the world. Everybody that buys along the way up here though, when something bleeds out like this, is sure kicking themselves in the ass for either not selling or for buying to begin with. So, but at the same time, you know, what we're looking at right here is, I don't think this thing has bottomed out yet. This is one of the ones where we're talking about a Fibonacci extension to the downside. The Fibonacci extension of our initial move from here to here gives us our target of the whoops, I did not mean to move that. Gives us our target of the 2.618 Fibonacci extension to the downside here, which you'll notice that, you know, from our move here, we got the 1.236 initial Fibonacci and bounced to the upside, and then we came down further to the 1.618. I don't know if you guys can see that clearly, but it's in green right here. That was our next bounce. Then we tried to move up. We got about the same reaction rally, and it failed. The same reaction rally, failed to cross the 821 back to the upside, and then it sold off. And now it's sold off down here to basically nowhere land. It stopped in the middle of nowhere. That's probably right around the 2.236 or the 2.0 or something like that. I don't know off the top of my head. I mean, we could throw it on here really quick and look. Yeah, it's probably the 2.236. Yeah, almost perfectly. So we can see essentially that that came down to our next potential target. I don't really use the 2.236 that often, but in this case, obviously, you could have made a nice play off of it. But again, I also wasn't trying to like just pick the bottom. That was a 100% move back to the upside from it. But then what happened? It just bled all the way back out. So I do expect it to come back down to the 2.618. And then also now, if we look at our red fib, which is in place, that is off the bottom there, which again is not a valid fib right now because this is our swing low. So this is not actually valid yet. But if I'm correct and we do come down here to like $6 on Wish, look at how this has played out price action wise. You know, like in hindsight when we're looking back at it. This was very clear resistance here, very clear support right here, very clear support right here. You know, the next level was right here, right here, right here. That's the 0.5. Here we have the 618, which was our bottom initially. It was clearly resistance right here. Here we have the 786, which was the initial move up here. So is it going to play out like that? I don't know, but it sure looks probable. It sure looks possible. So we'll wait and see, but I have a feeling that we'll be able to get this at the target that I have in mind, which again, you know, hey, you could buy right now and maybe you're getting a great deal on it, you know, in the future, but it could also still from this level dump another like 34%. So, you know, I'm just patiently waiting for a track to explode on. Gets done if you want and your ass will get rolled on. Or no, wait, that's not me. That's 50 Cent. Next we have Vodafone. Again, this is one that someone had asked me to look at. I don't like how this looks. You know, we got this. I'm probably going to put this to the side here. It's like a British or English communication company. You know, we basically broke down from the key support level here. This thing topped out back in 2000 and had a peak after that in 2007, a peak after that in 2014. So, you know, is it potentially having another peak again in 2021? Again, let's bust out our, let's pull out our time cycle analysis tool. If I actually knew where it was. I remember back when TradingView only had like 5 tools. Now there's more things than any. So we have basically a top right here, a top right here, you know, essentially a top right here. So is that going to be our next stop right here? And we're going to pull up to it? Yeah, maybe, but it's probably just going to be like another lower high, honestly. So we'll wait and see. But when we look at, let's go back to our shorter time frame here again. You know, when we look at what's happening here, we have like a low, a clearly higher low, and then clearly like a third higher low here. But we have rolled over now the 200 exponential on simple, and we're underneath it on the daily. So more than likely to me, what do I think is going to happen here? I think we're probably going to, you know, basically try to pop back up here, you know, get rejected, come back down, and then do something like this, and then just have like, you know, a heavy sell as we break down from this key level. And then the key thing to pay attention to is, does this hold this support? Does this hold this support? Do we put in a higher low than those previous times? You know, obviously we'll wait and see, but right now, this does not look like a good chart to me. And when we look at, God, I hate this drawing tool. When we look at like the longer time frames, it just looks very weak. And obviously it hasn't put in a new all-time high in 20 years. So probably not the best investment. It's like the XRP of like communications. But sorry, XRP guys. Sorry, Ripple. Bumble is next. Obviously had that nice trade on Bumble. This is one of the ones where we kind of took a shot in the dark. We had this very clear descending triangle, put the measure move in place, got the exact measure move to the T, which point in time we Fibonacci'd from the top to the bottom. And we'll notice that what amounted to the resistance, or I'm sorry, support during the initial descending triangle is the 0.5. And then we took that trade all the way back to the upside for over 40% in gains, took profits at that resistance as we expected that it would act as resistance and at least sell off. Now we have put in a higher low. There's potential that this is going to hold. And now what we have is an ascending triangle. And then we're eventually going to break to the upside and get the measure move, you know, potentially back to that all-time high again. I think more likely than not, though, this is going to chop around in this range. Again, we had spoke about this previously. There's an argument for there to be a trade to the upside here. And damn it. And we could, like, you could very easily say, okay, I'm going to put in a tight stop of 6.7%. You know, if we take out this previous little low right here and we break out of the triangle, I'm going to be out of the trade. It's possible we just get stopped out and then it moves up. But more realistically, you know, you have potentially a 19% back to our resistance here, or we have a 6%, 6.7% to the downside if we break down and put in a higher, lower low. You know, and that's going to give us obviously like an almost 3-to-1 risk reward ratio. So we could easily take that trade if we wanted to. I don't particularly love it, but there's no reason not to take it. But there's also not like amazing reasons to take it. Usually when I make nice gains on something, I'll wait for the chart to kind of like tell me what's going on. So if we start to get a little move back to the upside, if it looks like we're going to hold support here at the 236, you know, maybe I'll get back involved with Bumble. There's definitely a trade to be had if you're, you know, if I was sitting around with like an itchy trigger finger and I couldn't find anything else, I would probably take that trade. But I think there's plenty of other stuff. And again, you know, we had some killer trades last month for like 20 and 40% gains, like some super easy trades, including this one. And then crypto, we just had a bunch of amazing trades for like 20 to 40% gains. So, I mean, I don't know how much anybody needs to trade or anything, or how big anybody's account is or anything like that. But I'm pretty sure if we're making multiple 20 to 40% gains every single month in a market that's not making 20 to 40% gains every month, we're probably doing pretty good. Because even if you traded with 10% of your account and you made 20% to 40% gains and you didn't even touch the other 90% of your account, what did we do? Well, you did 2 to 4% of your total account using only 10% of your account. So you took almost no risk and got like over 2 to 4% reward. So if you extrapolate that times the year and say you did 3% a month for the whole year using only 10% of your principal, by the end of the year, what's our gains? Our gains are like 40 to 50%. I mean, that's killer. So again, I'm the patient tiger waiting in the weeds to jump out and maul my prey. I'm not going to just like take every trade that comes up and jump in everything. I'm not some options gambler. You know, I'm a very conservative trader, you know, and I like to make gains and I don't like to lose anything. So I do it the easy way. I trade the easy way, using technicals and waiting for the perfect setup and then bending that setup over and taking what belongs to me. Baidu, obviously, you know how I feel about these Chinese stocks right now. There's too much uncertainty in the markets. These were giant descending triangles. We have lost the 200 exponential and simple. You know, they are basically like sloping to the downside. Is it possible this was just a little bit of a spring and we're going to break back to the upside? It is definitely a possibility. I'm paying attention to that. You know, we all but hit my first target to the downside. Second target down here, much lower. We'll have to wait and see. I'm not ready to just jump in on these. When we look at the longer time frame charts here and we take off the drawing tools, you know, we're now below the 200 exponential and simple, and they're rolling over to the downside on the weekly. We have a very clear 821 cross back at $200 telling us to get out. We're very clearly, you know, showing a bunch of weakness. These look terrible. When we switch over to the monthly as well, you can see this is very, very bearish price action. The 8 has a strong slope to the downside. The 21 is sloping to the downside now. We're below both of them. And if we break down from the level we're at right now, the purple 89, we got the hard sell signal and 4 months of straight, bearish histograms in a row. If we break down from this level, where are we going next? I mean, probably down to like 136, maybe even 127. Looks very bearish. And you'll see, obviously, 143 is that 618 target, and then 112 is the 786 target. So, we have a couple zones that we're paying attention to, but right now, I'm just not loving these Chinese stocks. Not really interested in these Chinese stocks. Does that mean I don't want them in the future? No, I definitely do. I will definitely be back in them in the future. And part of a very good diversified portfolio is not just asset classes, but also, international plays as well. So, everything from China, which is a world leader and potentially like the next dominant power, or already on its way there, for the next 20, 30, 50 years, but also emerging markets as well. But right now, I have very little interest in the instability of China because of the Communist Party and obviously the plague that it unleashed on the world. Not saying that other people like the United States didn't have anything to do with funding it, Dr. Fauci, but also, that's pure speculation also. Actually, I don't even think it is. I think it's a fact at this point in time. But regardless, what was I saying? Oh, emerging markets obviously have, I love India. I think India is probably going to be one of the best plays for the next 50 years. I think some of the Middle East plays as well are going to be absolutely killer. Potentially even, Africa, all kinds of emerging markets out there that will be absolutely killer over the next like 20 or 50 or 200 years. But right now, there's too much uncertainty. India is extremely scary because what's going on over there. One, the instability with their government and some of the decisions they've made. Two, they're having serious issues and have an immense amount of casualties because of what's going on right now. And then, obviously there's crazy unrest going on in, Africa right now. There's everything going on with China, CCP, all this craziness. So right now, I like the safety plays during the uncertainty, and then we can kind of like branch back out when the time is right, when either the fundamentals line up or when the technicals are telling us to do so. But right now, a couple months before Cathie Wood, I saw this all coming and have not been interested in these. So I've been out of Chinese stocks and all but the last couple emerging market or foreign stocks. Baba, same thing. Alibaba, extremely weak. Same type of thing. Got a capitulation move to the downside, coming back up to retest that resistance. But I do not like how any of this looks right now. We blew through what would amount to, the area I would like to see as support, which would have been the top of the one right here. Is it possible that we have reclaimed this area and it's still going to look good? This is our massive Elliott wave structure in play here. Going back to 2015, we have a 1 to the upside, a 2 retracement of the 1. We have a 3 to the upside, a potentially 4 retracement of the 1 back to the top here. We have all but reclaimed that area on a monthly time frame. So could you argue that this is still valid? You could argue that. If we switch out to the monthly though, it's a little sketch because one of the rules for Elliott wave is that on a long time frame, the 4 cannot retrace into like the territory of the 1. So we had a small retrace inside there, but I think more likely what you need to see happen is this area act as support. What happened was we violated that area as support, and now it's actually acting as resistance as a previous all-time high. So what we had possibly been looking at as a Fibonacci extension target up to like $415, I'm now looking at as a invalidation break down, to retest some of these key levels. We also have this very clear parabolic trend line here in green, which we have broke down, retested, and then failed to act as support. It is now acting as resistance. So now that we violated, a 6-year trend line that was acting as support, and then we also violated the 1 of our potential 5-wave structure to the upside. What we want to see happen is if we zoom in here a little bit and we look at our little Elliott wave here inside of the 3, we have the top of the 1, a 2 pullback, the top of the 3, and then we have a 4 pullback, and the 4 violates the 1 on the monthly, but it does not close below it. So here's our top of the 1, here's our bottom of the 4 based on candle closes. So that acted as support, and then we continue to the upside. That's what we want to see happen. A 1, a 2 retrace, a 3 to a new high, a 4 that acts as support at the top of the 1, and then 5 continuation. But what actually happened was we broke down from the top of the 1 now, and we have violated that level. And more likely than not, this is going to be a failed pattern. And then also we see extreme weakness on the monthly as we have only bearish histograms. We have flipped the slope over red. We're in a very clear downtrend on the stochastics, and we're very close to entering into the bearish control zone. So in my opinion, this is no surprise. This didn't just happen overnight. We've seen this coming for months, got out of these plays months and months ahead of time, made massive profits on them, and now we just sit back and wait. Next we have Tencent. Again, Tencent just had some terrible news. CCP is basically just destroying these things on purpose, in my opinion. Again, we're at that same level though, where we're at what amounts to the top of the previous wave, and we're trying to find support at that level. We would expect it to act at least as some kind of temporary support and try to get a push back up. But again, we have to be very careful that we're not violating that and then like basically turning what amounted into a potential 5-wave structure into something much worse. And you could argue that this was our top back here in 2018. We got the hard sell signal. We had basically months of downtrend. We violated this slope line on the monthly. It turned red. We had already put in the bottom right here at the violation, and then we consolidated for what amounted to from 2018 until we took out that high was in 2020. So that was over 2 years sideways. But you could have bought a key moving average. You could have bought the slope flip right here, whatever, for sure. But, it took you over a year to get back to that all-time high again. So is it possible that this is going to act as support and that this actual flip of the slope line right here is going to end up being the bottom and we're buying this area off of the 50-55? There's definitely a possibility, and somebody stepped in and tried to do that right here. You can see very clearly the initial bounce off of that was somebody trying to buy the bottom, and then what happened? Well, it just started selling back off. It acted as support once again. But more realistically, if we wait till this monthly ends in 27 days, one of two things is going to happen. It's going to sell back off to this level or potentially lower, or it's going to bounce straight back up to the 21. So is there a risk-reward trade in play here that could be useful, that could be profitable, that could be reliable? Well, let's look at where we're at right now, because we're right smack in the middle of these two targets basically. So again, if we pull up our little tool here, we have a 1.8 to the upside, which would be 14%. And then we have essentially violating that low, which is a 7.8 to the downside. So we have a 2 to 1 almost risk reward ratio just to try to retest this monthly cross and stop it from happening, which is what we did the previous time. We broke down, came back up, stopped the cross from happening, went back up above it, came back down, almost happened again, but then we saved it and continued to the upside. So is that going to happen again? Well, based on what happened in our last bear market, there's definitely a possibility. But again, with the 2 to 1 risk reward ratio, is it worth taking a shot? Yeah, you probably could if you wanted to. But again, I'm not necessarily trying to buy it. And obviously, I would rather have picked the bottom right here and took it off of the moving average itself. So, but again, I wasn't trying to catch a falling knife, because we could very, very easily come down here to the 89 and now look at your risk reward ratio. Now it's 0.6. So no, you don't want that. So, that's why you have to obviously decide where's your invalidation key point. If you break down from that low, you're out of the trade and you were wrong. Obviously if you continue to the upside, and then easily it could bounce to the upside and then still continue to the downside. But again, I'll just wait for the easy ones. You don't have to take a stab at something, but you can if you want, obviously. But again, not financial advice. Diddy did exactly what we said, broke down from a key level, came back up, filled the gap right here, retested what was, our support, acted as resistance, and now it looks like it's rolling over, getting rejected, going to just continue back down to the downside. Is it going to put in a higher low and then rally? Who knows? We'll have to wait and see. BZ, again, same thing, broke down from a key level, came back up, closed the gap, broke down again to a new low, came back up, put in a lower high. What's going to happen? Probably just going to come back down and retest those lower levels again. NEO, by far the strongest of the Chinese stocks we're looking at. This thing has been going sideways for some time now. We're back at November 2020 levels. So we basically wiped out all year's gains just going sideways here. So as far as I'm concerned, dead money. And we're basically just barely staying above the 200 moving average. This is typically what happens right before a breakdown. You put in a high, you find support at the 200 exponential and simple, you find less support, break down from it, try to push back to the upside, make one final attempt to break out from new all-time highs, and when that fails and you put in a lower high, you come back down, find some temporary support, and then eventually capitulate down through it, and then eventually this is what the beginning of a bear market starts to look like. This chart looks a lot like crypto. This chart looks a lot like, Tesla. It looks a lot like a lot of other charts. It looks a lot like gold. And that's what I mean about, I don't care what asset I'm looking at. I can look at a chart pattern. I can look at what's happening on a chart and tell you, based on moving averages and Fibonacci's, what is very high likelihood of what's going to happen. And I can tell you exactly where it would invalidate that idea as well. And that's why technical is so important. TSM, Taiwan Semiconductors. Again, the fundamentals are scary on this. The chart itself looks bad. It's by far the worst of the semiconductors. Well, damn near. Intel is also extremely bad. Some massive bearish divergence on our longer time frames as well. We have the all-time high coming back here at 2000. We basically all but retested the all-time high here. And now here on the monthly, we have 1, 2, 3 drives of bearish divergence, a high, a lower high, a third lower high, a high, a lower high, a third lower high. This looks like it's getting ready to roll out. And typically when the third drive of bearish divergence plays out, I would expect it to essentially come back down to the bottom of the channel here. And then when that channel breaks, we would get our measure move, and the measure move more likely than not will take us down to either the yellow, green, or blue box. I would expect probably the 0.5. I think Intel is probably going to go to like $30. And I'll probably be a buyer somewhere around that range. But these levels, there's no reason to. Massive bearish divergence on the longest time frame that we're paying attention to, and by far the worst performer. Could that change? Could the semiconductor United States infrastructure and Intel gets a piece and they build a new factory and all of a sudden they go to like parabolic new highs? For sure. Could definitely happen. But let's just trust the chart for now instead of just hoping and wishing. What's that old thing? You can hope in one hand and shit in the other. See which one fills up first. I'll take the sure thing. Intel is more likely to shit the bed than it is to hope itself to new all-time highs. Nvidia, this thing looks great. Ever since the split, obviously, went from 800 to 200s, sold off very nicely to the 55 exponential moving average, saved the 821 cross. Let's see now, does it put in a new all-time high, or does it get rejected here and then start showing some bearish divergence? I don't know. I mean, definitely the stronger, or one of the strongest, not anymore though, of the semiconductors, as AMD is absolutely crushing it. Advanced Micro Devices straight up dominating. Is this a meme stock? Is it a semiconductor company? I don't even know anymore. I don't think anyone knows. We'll see. Let's throw a couple fibs on here and see where our targets are for what's happening. And just because this is a meme stock now, does not mean it's not going to respect the technicals. So if we just go from our high right here down to our low right here and look at where we're at. Oh, look how convenient that we should randomly just come up exactly to the 1.618 and then get rejected. Are we going to continue to the upside? Sure, maybe. Could we get up as high as the 2.236 or 2.618? Sure, maybe we come up here to 145. Maybe we come up here to 164. I don't know. We'll have to wait and see. But this is a very, very high likelihood that this is topped out. Am I going to take some options plays on AMD? Maybe. Possibly. We'll have to wait and see. But right now, there's nothing that tells me this can't just keep running to the upside. Where potentially, if this starts to roll over, it could put in some bearish divergence. Is the knife at just ridiculous levels and probably topping out? Yeah, probably. But again, a short squeeze can just go nuts. So Zoom actually looking nice here. This was obviously our very clear descending channel, broke out. It didn't hold as support, which I don't love, but also, you know, and this is another thing that I don't think I ever actually talked about, but you could argue that my channel is not drawn in here correctly and that there's actually something more like this. And that actually makes this chart look much more bullish, in my opinion. Because that's basically ignoring the initial top here, using this top here, using this top here, this top here, and then this was a clear resistance, broke through the resistance, retested it as support, and the 200 exponential and simple, and then it actually held support. But the way I had it drawn, it looked like it basically fell through support right here, so I was a little less bullish. We got to be careful though. The 200 simple has already rolled over. The 200 exponential has been saved for now. This is obviously a key resistance. Could this trade easily play out for like a 35% move to the upside? Sure, definitely could. And I mean, even if you didn't get into that trade already, I mean, is there still a trade to be had here somewhere along the way? Probably something still juicy. Yeah, you could still take a 2-to-1 risk reward on this. If we broke down through that low and back into the channel, that would be a 12.6% stop loss. If we broke out to the upside and hit our initial target and some of this key like resistance or the measure move of the channel itself, that's 25%. So again, 2-to-1 risk reward ratio. We're technically above both the moving averages, 200 exponential and simple. The 820 of them across to the upside. The fundamentals, you could argue, are strong for this. The technicals are strong because we broke out of a descending channel, which is typically a bullish breakout. So by all means, by all means. And then if we look at our weekly chart, you know, we crossed the 821 back to the upside right here, moving up since then. Could it get rejected and do the same thing it did last time? Yep. Could it easily continue to the upside? 100%. 100%. Definitely seeing some green histograms. Got the hard buy signal back here before the cross, leaving the bearish control zone. It is now inside the bullish control zone. So again, if this holds, could easily see further upside potential, and this trade setup could easily play out. I did not take this trade setup, again, because of maybe I had my channel drawn slightly wrong. Maybe this thing is actually weak and I have my channel drawn right. Only time will tell. Peloton next, just chopping around sideways since this. I do still expect this to come up here to the 786 at like 145, but it could easily get a little double or triple top rejection right here and play out to the downside. I still don't like it. Maybe this is, if everything shuts back down though, we go back into lockdowns, all of a sudden Peloton explodes to the upside again. Because I mean, when did this stop? Around December, you know, it started selling off. So definitely a possibility. Definitely a possibility. All right. I want to start off by saying I do owe someone an apology. I do talk mad trash about Cathie Wood and her underperformance. And you know what? She finally picked a winner. Old Robinhood meme stock. She did it. She bought Robinhood. It went up like 50% in like a day or two. I got to give her congratulations. I got to. I absolutely have to. When I'm wrong, I'm wrong. Mad props to you, Cathie. You did it. You picked a winner. And you put it in your ARKK fund. You bought Robinhood. You picked a winner. It went up over 50%. And let's look at what happened to your stock. Let's look at what happened to your ETF. Great job. Great job, Cathie. You nailed it. The ARK Funds is officially up 2.7% because of, probably, at least mostly because of Robinhood. So you did it. Would I have rather just bought Robinhood and been up 40% or whatever it was? Yeah, probably. But hey, you know what? Cathie, I'm going to give you your props where props are due. You finally got a winner. Let's see, did she sell it before like the meme stock squeeze runs out though, and then it sells off, and then just like, worst case scenario though, if it drags it down, it's just going to drag it down to here. But I did go through and look at like all the ARK funds in the, like, I think it was yesterday or something, and ARKK is still the strongest by far. We did have a nice trade in ARK earlier with our target up here to 132. That was definitely a nice trade on the breakout and everything. I'm not back in this. We did put this trade set up in place for a potential target up to the 786. could still play out for sure. Again, I'm not interested in it right now. I don't like how it's reacting off of the 200 exponential and simple. The initial bounce was nice. The second one was about the same. And then we broke through it, came back up. It acted as resistance, tried to save the trend. It failed, came back down below the 200 simple. The 200 exponential did save price action. But this to me looks like it has a very high likelihood that it's getting ready to roll over. It's getting ready to fall out of bed, capitulate to the downside. And if we look at our weekly time frame, we can see very clearly we are barely hanging on to this 821 cross. We are very, very close to this crossing back down to the downside on the weekly. I'm putting in a new low. This to me, again, this was our hard buy signal, and the Stochs are almost all the way up in the bullish control zone. This is where they cross to the upside. And where are we at right now? We're up from where we got the cross to where we're at right now with the Robinhood pump, 3%. So these went all the way from, the stochastics went all the way from across at 28, all the way up to 75 right now, and we went up 3%. So what does that tell me? This is probably a bearish reset taking place right now. This is like a reaction rally off the bottom. We're resetting the Stochs back to the top of the range, and when they get up here high enough and they start to sell off, they're going to have the entire range to go to the downside because they're going to be all the way at the top getting rejected off the bullish control zone. Could I be wrong and this continues to the upside? Yes, it's possible. Is it likely? No. This looks like what's happening in most markets. And then next, if we look at ARKF, this one I think is giving us a much more realistic view of the other, whatever it is, like 7 or 100 ARK funds that she has right now. Most of the other ones are underperforming. This is the FinTech Innovation one. Did not even get up to our key fib level 786 target. Did not even get, actually at the time that was a different target, but still again, 1, 2, 3, 4 times it's gotten rejected and putting in lower highs since the initial dump. Again, very pathetic moves off the 200 exponential and simple, barely staying above them right now. Could it hold support here and continue to the upside? It is definitely possible. Slightly has crossed the 821 back up, but it's having a real hard time here. So either the bears are really trying to push this down or the bulls are really trying to save it. But regardless, again, it floated from the hard buy signal back here at 38. That was like our cross right here on the 821. It floated back to the upside. And where are we at? We're back up from the cross right here or from the hard buy signal, which would have been right here. We're up like less than 1%. So the indicator has cruised all the way back up to the top of the range and ARK is up 1%. So again, what does that look like to me? That looks like a bearish reset. And then eventually, when the time is right and these indicator oscillators are at the top of the range again, we're just going to sell off massively and then it's going to fall out of bed and put in a new low. So, Kathy, if you're listening, I'm not trying to hurt your feelings, and I do give you props on buying the hood, but your funds are not looking good right now. It's not looking good in the hood, if you know what I'm saying. Skills. Okay, so here's a couple requests, a couple new charts here. So Skillshare, ticker SKLZ. Okay, look, so this thing basically April 2020 was $10. Massively ran up to $46. Sold back off to essentially where we're at right now. Got a dead cat bounce, and now it's back retesting that level again. So we're at $12. So what does it look like is going to happen here? Let's use a couple Fibonacci's and see what's taking place here. So from our bottom to our top, basically we topped out, came back down, essentially bounced like the 786 level right here, got rejected at the 0.5, bounced to 786, got rejected at the 382, bounced to 618, got rejected at the 0.5. This thing is trading very technically. Bouncing the 786, lower high, and now here we are at the 886. So is this going to end up being the bottom right here? And, we can take a nice trade off of that. Maybe. Could it easily just continue to sell off? Sure. I mean, this one is just, it'd be trying to catch a falling knife on this thing. Okay. If it breaks through the 886 by more than a couple percent, maybe we get out. If it retests the 786, what is that? 16% to the upside, 7% stop loss, 2-to-1 risk reward ratio. Could we take an entry off that 886? For sure we could. Does it probably come down here and just retest the $10 range? It probably does, or worse. With these specs though, it's probably not going to go. I mean, it could easily go to 1.236 is like 675. It could easily go there. That's where I would really start getting interested. If I was going to take a little scalp on this. But I mean, at this point in time, you got to see some kind of life out of this thing before you just take a stab. I mean, I do anyway. I mean, when you start looking at the monthly chart on this thing, I mean, does that look good to you? We're doing great, guys. We're crushing it. We're going all the way up. Uh-oh, that's a rejection. Oh, my God, no. Oh, we're going to zero. No, we're not. We're doing fine. Oh, Jesus, we're dead. We'll see. I don't know. Maybe it's fine. Everything's fine. We're fine. Skills is fine. We're good. It's just a little gap down. Speaking of gap down, Teladoc is next. TDOC ticker. Again, okay, so what is this doing right here? So we're in a nice uptrend, consolidation here, when we're like losing the 200 as support, exponential and simple, crossing back to the upside, nice uptrend. And now here what happened? We put in an all-time high off the retest here. We came down, broke through them. They acted as resistance. We didn't even get up to them. So now we have the 89 acting as resistance. So could we easily come back up and get a retest up to like $200? We for sure could. But at this point in time, the 200 exponential and simple are both sloped to the downside. We're well below the 377, which now has a downside slope. And now here we are below the 528 as well, which has a neutral slope about to go to the downside. So we're below all of our daily moving averages. It looks like this thing is just literally getting ready to capitulate. Could that change again if like lockdowns happen or something? For sure it could. It 100% could. I would expect the weekly 200 exponential to act as support around $123. I would expect the weekly 200 simple to act as support around $110, or I would expect the previous all-time high back here at $87 to act as support. And again, let's just throw a couple key areas in place and we'll see how those correspond. This was obviously a low here, corresponded with the rejection right here. This was obviously our previous high right here, acted as resistance here, and then we broke through it. So could we come down and retest those levels? For sure, we definitely could. And then if we just switch over now and look at a Fibonacci target and see how the Fibonacci's correspond to those little lines that we threw in there. See, are these market makers, are these algorithms using Fibonacci, or are these just made up things and they just added them to TradingView for the hell of it? Well, I would say that previous all-time high corresponds almost perfectly with the 618. I would say the 382 corresponds very clearly with what was resistance here and support through here, and then obviously support through here and then support through here. If we break down from this, I would expect this to come down to the 0.5, which is $113. And then again, if we go back to our weekly now, let's see how that corresponds with our moving averages. Depending when we get there, that's essentially going to correspond almost perfectly with the 200 simple. So the more levels of confluence we have, the more likely it is to play out. We are seeing a little bit of bullishness here on the indicator oscillators. We're seeing a hard buy coming out of the bearish control zone. But what happened? We moved up, got rejected, and it looks like we're probably going to come back down. Could we break through this level, put in what amounts to a higher low from this point, and then continue to the upside? For sure, at which point in time, I think the 236 at 192 will be a very difficult resistance to get through. But we'll have to see how that plays out. But again, I'm not trying to just buy into this thing when it's very clearly has just entered into a bearish downtrend on the daily. And if we look back here, at the previous time when that happened, here we broke down from the 200 exponential and simple. The exponential obviously responded quicker, but the simple was still in an uptrend. Here, the 200 simple goes into a downtrend and rolls over. Let me zoom in a little bit. Rolls over right here, and then, obviously acts as resistance the next couple times we get into it. But if you just counted from once that rolled over here to once we broke back above it, that was 105 days. So, the next like 3.5 months, and then realistically, from when we actually confirm and break back above that previous high and get continuation, you know, what are we looking at? Well, from when we broke down below it to when we act as support and break above it, you know, that's 200 days. So, you know, the better part of a year, essentially, sideways. So if you have unlimited capital and you want to just buy whenever, that's fine, and it'll probably eventually recover. But for me, I have limited capital, and I like to put it to work in useful places. And right now, Teladoc does not look like a useful place to put capital, in my opinion. So next we have Corsair Gaming, CRSR. It is no secret that this is a popular stock. It is no secret, obviously, if you can see my little, you know, mini picture down there of my CPU, that I am a believer in Corsair. As you can see some clear Corsair parts. They make great parts. They're awesome. Let's look at the chart and see how awesome that looks. Well, it does not look good. From the high, from the low to the high, we got a lower high right here, rejection. Come back down and retest the 382. We basically went sideways. You know, that was November 2020. So for this entire year, we went sideways, just putting in lower highs. And now here we have broken through that 382 level down to our 0.5 almost perfectly. I would, of course, expect a reaction rally off this area to a lower high. Could we take a position off this? We do have the, you know, bullish divergence signal, the buy, sell, buy in the bearish control zone, at which point in time we put in a new low. So are we going to come back up and at least fill the gap? Could we easily get just another lower high push up to like some random area in here? Is there a trade to be had right now? Yeah, I think so. There's probably something to be had, at least there. And then, you know, if we obviously start losing this level and that wasn't the bottom, is there something there? Yeah, there's a 2-to-1 here. We could definitely take an entry right here with a 13% upside to retest the 382 or a 6.6% stop loss if we take out that previous little low right here. Yeah, it's 2-to-1 risk reward ratio. It's definitely worth a shot. But I mean, is that going to be the bottom? Was that it? Did we just catch a knife and we did it perfectly? I think probably more realistically than not. I think we're probably going to be coming down here. Is it possible the 0.5 is the bottom? Yes, it's definitely possible. I think we'll probably come down to the 618, especially if like the rest of the market starts showing weakness and this has already been massively underperforming. I think we can get a buy here at like 23 bucks. And then more realistically, if this thing really starts to take a hit, are we going to be able to get a buy back down here under $20? Yeah, probably. We probably are. In the meantime, is there a scalp to be had? Yeah, probably. But let's look at our weekly, and this is when things start to get ugly. The 821 cross right here, it gapped up trying to save that 821 cross and then just massively dumped. Obviously, after a candle like this on a gap up capitulation below the 821, that was basically the death throes of Corsair Gaming. That was probably someone pushing the price back up here so they could get out of their massively underwater position. And then once they did, they took a dump straight on everyone's face. We're down at the 0.5 now. There's no reason to be in this thing when we're clearly in a downtrend, just getting absolutely destroyed with massive giant red bearish candles after bearish candles after bearish candles, putting in consistently lower lows and lower highs. Every push up to the upside on a monthly is a hard rejection. And every push to the downside is just a new low on the monthly. Doesn't look good. Are their computer parts good? Yep. Is their chart good? Fuck no. Dun, 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 dun. Wow. Sorry, Corsair. I still like your stuff though. It works good and it's pretty. It's got lots of bright colors and it's cool. But man, does your stock look like shit. Etsy is next. Okay, so if I'm not mistaken, am I mistaken? No, I'm pretty sure today. Yeah, I'm like 95% sure that Etsy had, hang on one sec. I'm 99% sure that Etsy had a capitulation dump after it reported its earnings today. Hang on. I'm looking and I'm a liking. Yeah, I'm pretty sure it got crushed after hours today. Wow, that was a process. Okay, yes. So it did. It went down $27 after hours and 13.86%. So again, it was the same exact thing happening. They didn't do bad on earnings. I think it was a beat. It was overall decent, but they're not growing, and the majority of their sales is coming from the same people. So they're basically seeing what amounts to a top in growth or a peak in growth, which is we're seeing over and over again as things report, beat or at least do okay, and then just get absolutely crushed. So it was down $27 after hours from 202 and like 14%. Yeah, so it basically closed right around 174 after hours. So it gapped down or went down to below the 200 exponential and simple. So again, we bounced the 200 exponential and simple, try to come up, put in a lower high, and then obviously get a capitulation move back down below them. They're both looking like they're getting ready to roll over. This looked like a death throw trying to save price action. And again, a 14% gap down. Do you all of a sudden want to buy it and say, oh, it gapped down, or after hours went down, so that's great. We can just ride it back to the upside. Well, I think it's probably not going to the upside. It's probably going to just consolidate in this range right here and then roll over the 200 exponential and simple. So we'll wait and see how that works. But again, this is not unexpected by any means. I was expecting a potential top back here at what was our support, acting as resistance. We broke out of the channel, underperformed to the 618 from the high to low, did not get the measure move back to the top of the range. And now here we retested it again, failed, put in a lower high, and then gap down back inside of this range. And you guys know, obviously, by this old trade setup I put up in here, I have been expecting for some time this to come back down, revisit the previous lows at like 150, break through that area, and then come way back down here to somewhere around like 111. So will I get my buy at 111? Will I even be interested at 111, or will it go lower? I don't know. We'll have to wait and see, but it's looking very probable now after getting crushed after hours. So Square obviously had that big acquisition and had a nice little pump up, but what happened? It basically just came back up to its resistance. It's just been trading inside of this channel, and essentially it entered into the channel back here in November, chopped sideways this entire time, back at the top of the range. So what do we say about channels? What do we say about patterns? If it's operating inside of the pattern, it's more than likely going to continue operating inside the pattern until it doesn't. The one time it breaks out, if it consolidates long enough, retests our breakout point as support, then we could expect continuation to the upper downside. But for now, more realistically than not, what's a trade to be had on Square? I mean, no matter how much you like it, it's probably something like this. It's probably 27% to the downside with 7% to the upside, assuming it gets a confirmed breakout or if you just want to take it back to the heart line, you know, 13% to the downside with 7% to the upside. So again, 2 to 1 to the downside risk reward ratio, which could easily be taken, you know, with some nice little options plays. But yeah, I mean, that's what I'm expecting to happen. I do not currently have a position in Square. Next, we have eBay. eBay got that nice little breakout. Then again, you know, got its random little like dump down here. Not as bad as some of the other ones like Pinterest and Etsy and whatnot. Amazon even. Well, percentage-wise, I think it was right around what Amazon did. But now here we are. The last 2 times we were able to save the 821 cross. And now here we are getting the 821 cross. Finding support at the 50-55. But essentially, it looks like we're about to just come back down and retest our ascending triangle breakout. So it looks like this trade is going to end up failing. Again, I missed this trade because we broke back down and did not find support at the top support right here. If we break through a resistance, I always want to see an SR flip. I want to break through resistance. I want to see support hold, consolidate, and then I want to take a continuation trade to the upside. When we break through and then we all of a sudden fall right back inside the pattern, I don't like that, even if we break out afterwards. So again, I skipped out on this one. It would have been a nice position regardless, even without the target getting hit. If you took the breakout trade, it went up 12-13%. But the reason it probably underperformed is, you know, more cautious or intelligent or whatever you want to say, conservative investors or traders like myself don't like this little price action right here. So aren't going to get involved in it or are going to get out at the first signs of weakness. So in this case, you didn't even have a chance to get out because it immediately just gapped down and then sold off. Again, it's not crazy. It's not like it's going to blow out your whole account. But what does it look like it's going to happen now? Well, it looks like it's going to come back down here and test this breakout again. And I suspect it's probably going to fail. I don't know for sure, but it looks more likely than not. We see some very clear bearish divergence taking place. eBay does not look great. PayPal, another one of those ones that, you know, underperformed on earnings, obviously, because eBay kicked it to the curb. We had a very nice trade here on PayPal of like basically 17% to the upside, just retesting our previous high. We had in place a potential for a continuation trade up to our next breakout point, measure move on 1.236. Obviously does not look like it's getting there. And obviously has sold back down to our potential target here at the 618 of the entire move up here. Is this going to hold? I don't think so. I think it's probably, with how violent that move happens, it's probably going to come down to at least the 0.5. It could very easily find support. There's quite a bit of confluence here. We have the 89. We have the previous resistance acting as support. We have the 618. You know, do we come back up here now and get that gap fill close? I mean, probably, honestly. Does it have to happen? No. Is it likely to happen? Probably. There's, again, you know, 5% downside, 9% upside here. You know, essentially what amounts to 2 to 1 risk reward gap close. You know, again, not a beautiful trade setup in my opinion, but it doesn't look bad. It does look like it found some decent support here. But again, this is not a cake trade. I like those cake trades. But there's definitely potential to be had there. Apple obviously had a nice trade on Apple. Still active currently. Target up here is 17.47% with our flag breakout here. After we broke out, we find support, and then we see straight up continuation. You know, reclaim a key level here. You know, Apple's great. It's like basically propping up the entire market right now. Probably one of the best charts. And what's it doing? Well, it had a nice flagpole move to the upside, and now it looks like to me it's putting in another flag pattern. Depending how you want to look at this, it basically looks like, you know, something like an ascending triangle slash like just standard flag, but basically has just reclaimed this support from back here, you know, broke down from it here, found support, moved back up, acted as resistance, broke through it, support, support. It looks like now we're just forming another flag. And then if we get the flag breakout from this point in time, you know, there's 2 ways you can measure like a breakout like this. The conservative way is basically from your initial point touch to the bottom up to the top of the pattern, and then you just extrapolate that. Damn it. You just extrapolate that from the breakout. So that would give us basically up to our 1.382 or 2.5 level. and the majority of the way to our completion of the trade setup. The other alternative and more, I guess you could say, like aggressive or ambitious way of doing the measure move is you take the actual flagpole from the breakout to the resistance point, and then you just extrapolate that from the actual breakout itself, and we can see once again that would basically give us the final completion of our move, and then also like around like a 167 level, somewhere around there. So those are like the two standard ways of charting them. One is obviously more conservative, but more likely to play out in the event that this is in fact an ascending triangle, or like a bullish flag pattern. All right, so Amazon next. Again, Amazon's another one of those that broke out to new highs and then had that gap down. Does it come back up and fill the gap? Sure, maybe, but is this terrible thing to see happen? Yeah, and is it barely just like hanging on to its 200 exponential and simple moving averages now? It is above them for now, but I suspect before long it's going to be back down below them. And this was our price back in July of 2020. So if you were a buyer in July of 2020, or maybe August of 2020, your whole entire year just got wiped out. You sat around for the whole year and you're still right back where you're at. You waited for this breakout to happen. It finally broke out. Maybe you even bought the breakout because you're a breakout trader and you liked how it worked, and it came down and it found support at the breakout level, and you got extremely bullish because you're like, finally, Amazon's breaking out and we're finding support. Let's go. And then it put in a lower high and then capitulated back down. And now you're upside down in your position, or you're dead even in your position, and your money's just been sitting around for a whole entire year on what was probably the #1 beneficiary from the entire situation. I know Jeff Bezos probably made the most, if not top 3 most amount of money of any single human being. His wife's probably on that list too. But let's be real here. Amazon sucks. Now, not the service, but the chart. Facebook, got the breakout, came back down, finding resistance at that little high. I don't like how it looks. I don't love how it looks, but probably one of the best looking charts in the market right now. Probably continues to the upside. And these FANG stocks are basically like propping up the whole market. At least the big indexes, and then also themselves, probably dragging up a bunch of trash with them, making the whole stock market look much better than it is. Google is next. Google had a nice little gap up, came back down, all but filled that gap there. Still above the 8. Showing a little bit of weakness here on our daily, but overall, one of the best looking charts. And then finally Netflix, again, total trash bag, bum stock. Basically saw its little pop out from its previous highs here. That was like June, July 2020. Broke out essentially of its previous range right here. This was its all-time high from 2018. Went sideways from 2018 until April of 2020. So it spent 2 years sideways to down. Finally broke out from that. And now since then, it has just spent the last 1 year sideways doing absolutely nothing. And again, probably one of the top beneficiaries of the pandemic. So if this is not doing well, if Amazon is not doing well, if the 95% of the other stocks we looked at today are not doing well, what does that tell you? Something's probably not right about these markets, and the likelihood of continuation is probably not very high. But does that mean these things are going to sell off tomorrow and we should just pull all our money out and just sit on the sidelines? Hell no. All right, so let's jump in the comments, see what's up. Okay, I obviously have bored you guys all to death because you have not said anything through all of that period. But I'm glad to see you guys are still here. AW going strong. That's what's up. Glad to have you, fam. I see the likes are up, 1 for each of you. Excellent. Good job, my friends. Remember, if you're just showing up, which I'm sure you guys have probably been here the whole time, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. Let's get to the nitty gritty, the crypto. All right, so here we got Bitcoin CME futures chart. So the CME futures chart looks much better than the spot market does. We have maintained above the 200 exponential and the 200 simple. Our retest was of the 200 simple. We got a pathetic move after that, but we're now at least finding support on the 89. We're in the bullish control zone. We got a bunch of green histograms. We flipped the slope back over blue. The whole market is super happy. We got a higher high than this previous high. Guys, we're doing it. Bitcoin to the moon. They're saying it again. 75,000, 100,000, 250,000. Jesse, oh, we're doing it. Let's go to the moon, baby. We're going to 1 million. Bitcoin's market cap to 10 to $20 million according to Kraken. We're doing it, Dan. We're doing it. Probably not. Let's calm down there, guy. Let's calm down a little bit, okay? Let's calm down. All right. We got some targets. Maybe we get up to 47, 48, 50,000. But let's just calm down here, okay? Let's relax a little bit. All right. Crypto moon boys, let's chill. Bitcoin still looks terrible. It just looks less terrible. Okay. Here's our weekly chart. We're back above the 21. We're holding strong. We're above the 8, obviously. We're trying to cross this back to the upside. Let's see how the next couple weeks look. We got a nice little 20 to 40% gains on some of our scalp trades. We took some profits. We still have some open positions in Bitcoin, Ethereum, and some of the other shitcoins we'll be looking at tonight. But let's not get crazy. We are still in the bearish control zone. Very clearly. We're looking like we want to cross eventually and maybe exit it. We have what amounts to potentially 2 green histograms for the first time on the weekly. Starting to look decent, but let's remain calm. let's stay chill, folks. We did leave behind a gap back here at 32,000, which is not good. Do we have to fill the gap? Nope. We have left gaps in the past. Eventually, will we fill the gap? Probably about a 95% certainty. But it could be months or even a year from now. Bitcoin spot market. Okay, this is what I'm talking about. We did not make it up to the 200 simple moving average. We did break above and find support at the 200 simple exponential rather. We were not able to close above it here, but then we pushed up and we closed above it today. So that's good. That's definitely good to see. We are back above it and consolidating for now. We are seeing what amounts to leaving the bullish control zone. We're seeing our stochastics cross to the downside. They're about to get the hard sell signal. We are seeing all red histograms for the last 5 days in a row. We're still above the blue slope line, so it still looks okay. There's still a very high likelihood that we push up here. We hit our 45,000 or 44.6 target and get rejected by the 200 simple moving average and put in some divergence on the daily. Still very high likelihood that happens. Weekly chart, again, we're trying to get above the 21. Slight rejection here. In between the 8 and 21 now, trying to cross it to the upside. If we consolidate here long enough above 40,000, we'll cross them back to the upside, and I think we could get continuation. Again, though, let's not get too excited yet, guys. This is exactly what I would do if I was getting ready to unload my remaining bags on stupid suckers. This is right before we go into a multi-year bear market. This is exactly what every chart looks like right before it goes into a bear market. It attempts to save the 200 exponential and simple moving average. And matter of fact, in case you don't believe me, let's look at our last bear market. Let's go back to 2017 and we'll just remind ourselves what it looks like. So here, we all-time high at 20,000, go sideways, break down below the 200 exponential and simple. They act as resistance. We find support. We break through them. All the moon boys get bullish again. We're doing it, guys. We're going to the moon. Oh, shit. No, we're not. And then the 200 simple rolls over. The 200 exponential rolls over. We go into an official bear market. We one more time come back up, retest them. We try to get above them. We break above them, back up to $10,000. We're doing it. We're doing it. And then we capitulate all the way down to 3,800. Oh, did I go to the wrong one? Whoops, this is the 14,000 top. So that one was actually slightly more bullish. But you can see the effect. Here's our 20,000 top. And again, 20,000, come down, break below the 200 exponential and simple, try to get back above them, hold on for a little bit, fail, come back up, break above the 200 exponential here, go sideways, finally get a push up to the 200 simple, touch it, come back up one more time, try to touch it again, fails, they roll over, now slope to the downside, now slope to the downside, and then what happens? A year of sideways to down action. If you got bullish back here, which was our 10,000 is the new, or 40,000 is the new 10,000. What happened after that? Well, we sold off 66% of the way down to $3,000 and went sideways to down for an entire year, and crypto died, and altcoins went down 90%. A lot of them died. There was no crypto influencers. No one gave a shit about Bitcoin or crypto or anything else. So is that what's about to happen right now? Are we going to push up to 44,000 and then lose 66% of our value and go down to like 15,000? Well, you better pray to God that we don't, because that would be the first time we have ever violated the previous all-time high of a 4-year Bitcoin cycle, halving cycle. And that would probably mean that there's serious downside. But again, does that have to happen? No, we could easily go to the moon. But right now, this looks like what every market does when it rolls over before it goes to a bear market. So Bitcoin on the daily here, seeing some very nice buying come in. Nice little like 20 to 40% move depending where we got our entry at. Very blue, nice slope line to the upside, nice volume coming in. And now here we're seeing our volume has rolled over down to almost nothing. The slope line has rolled over to yellow, so we're losing strength. Still somewhat bullish. There's still some buying coming in, but we have lost our strength completely. Here we have a peak very clearly on the Fisher Transform, and we're seeing more buying than selling volume coming in now, which is good, but also what's necessary to, essentially push a price target up through what amounts to, our triple bullish divergence short squeeze. So again, let's be very careful here. Let's not get too crazy yet. It's definitely potential that we could do something here. But we're seeing on the weekly chart, all bearish volume coming in here. While we're losing strength to the downside, we are still seeing more selling than buying taking place. This is bearish. While the Fisher is starting to roll back to the upside, we could very easily see a double peak like this. And then we want to buy the second peak. We don't want to buy the first peak. And then it just unpeaks. And then again, if we look at buying and selling on the on-balance volume, we'll see that we are barely hanging on. We're seeing very little buying coming in, just enough to hang on, but we're seeing the slope line start to roll over. And when we've seen the slope line roll over in the past, what happened? Well, this was our bear market of 2017. And then we finally, we save it here. It flips over red. We save it. Flips over red. We save it. Flips over red. We save it. Save it. Save it. Capitulation. And then we see here, once we lose it, a couple times we try to save it, but this is bear market. This is bear market territory. This is bear market territory back in 2014. And now what does it look like? Well, looks like some definite potential bear market territory. So let's not get too excited, guys. Let's not be loading up on Dash or anything. And then if we look at just our traditional MACDs rolling over, RSIs rolling over, stochastics are rolling over. I would like to see one more push up here to like the 618 around like 4,700 and hit the moving average, and then also a little bearish divergence and see that roll over. Ethereum looking nice here, guys. Looking nice. Definitely still have an active position open on Ethereum. Just put in a new high, so that's nice. While Bitcoin goes sideways, which is what Ethereum tends to do. We are in the bullish control zone, pushing up here. A bunch of green histograms. Nice blue slope. Looking good, looking good. We have some serious resistance here at like 2,897. Could we push up even higher than that? Sure we could. We stayed above the 200 exponential and simple moving average. We're going very nicely. Ethereum looks exponentially better than just about any other crypto. Definitely Bitcoin. We saved the 821 cross. We're coming back up. We're at some key weekly resistance right now. I want to see us get up to 3,000 next. After that, I want to see us get up to 3,500. After that, I want to see us get up to 4,000. After that, I want to see us get up to 10,000. Is it going to happen? Probably not. A bunch of red histograms in a row. Couple green ones. We're still well below the slope line. It is still blue, but more than likely we're going to continue up slightly, get rejected, and then sell off, and probably trap a bunch of Ethereum bulls in what amounts to another 75 to 80% sell-off. Okay, so what's going on with Ethereum to Bitcoin? We have a very clear descending triangle here in red. We have also a descending channel here in yellow. So if you're looking at just the descending triangle, we broke out and we're consolidating and we're getting ready to go to infinity, and you're bullish on Ethereum. If we're looking at our, descending triangle and our channel here, it looks more than likely that we broke out slightly of our little triangle, but we're at resistance now. If we consolidate here long enough, Bitcoin gains on or Ethereum gains on Bitcoin. If we get rejected here, this is probably our lower high peak for Ethereum to Bitcoin ratio, and we want to sell all our Ethereum and move it into Bitcoin or the majority of it, etc. This is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. Ethereum's going to zero. Yeah, it looks okay. Bunch of red histograms in a row. Finally saw a green one. Hard sell. Move back up to the top of the range. More than likely, what happens when we're range bound like this, we're probably going to sell the top. We're going to sell the resistance. We're going to buy the support. So again, that's why we bought Ethereum down here at the bottom. That's why we sell our Ethereum here at the top. But we always keep some, and we always keep a little Bitcoin just in case we're wrong. Because you got to have that corn, folks. That's how we make our ethanol. Or in Bitcoin's sake, our bethanol. Uniswap, again, open position on Uniswap. Took some profits along the way at the 89. Still have part of that position open. Find support. Nice push up here. I do expect this to come up to the 200 simple eventually at $25. BAT took some profits here at the, I think it was at the 89. It went slightly higher here. Again, still part of the position open. Find support here. Looks like we're going to get our push up here to like 78 cents, at which point in time I will probably close at least half of what's still open, if not the remainder of my position. Doggy Dogecoin, still looking like a, they should change the name from Dogecoin to like Dump Coin or like Fecal Matter or something, because this thing looks like shit. It's literally getting nothing. There's no one buying Dogecoin. There's no one wants Dogecoin anymore. All the other meme crap is better than Dogecoin. Dogecoin is garbage. It looks like it's about to roll back over to the downside. It could not even hold above the 200 exponential moving average. It's still barely above the 200 simple. So you could argue it's doing better than other things because it's above or at its moving averages. But the recent price action on Dogecoin is just pathetic. Pathetic. Where you at, Dojies? I don't know what their nickname is. Where you at? Shibitsus or whatever. Polkadot, same thing, underperforming in my opinion. It's been a nice move up from the bottom, but still has not even touched the 200 exponential. I mean, once it gets to 200 exponential at $21, we could start looking at $27. But look, I mean, it's not even at the 200 exponential yet. Again, close part of my position on that. These are all the same though. I took the position at the 821 cross. 40% move to the upside. Very nice move. Obviously, even nicer move if you got into it from the bottom. If it keeps moving, what are we going to close the remainder of the position at, or the majority of the position at? Maybe it gets up here to an 86% gain. Sure. Does that happen? Probably not, because it's severely underperforming. But if Bitcoin goes sideways long enough and starts losing strength in the market, alts could easily pop up here. But why is DOT doing so terrible? Link is next. At the exponential, closing at it. This one looks likely to get our push up here to the 200 simple, 27.86. Again, close part of my position already here. Yep, same thing, same exact chart, slightly different. XRP, again, technically looks better than some coins. Looks terrible on the macro because it didn't make a new all-time high this cycle. So while other things went absolutely parabolic, even shit coins like Dogecoin went absolutely parabolic. And then we look at the XRP, we look at the cult, and the cult is literally just getting smaller. It's getting worse, because here was our top in 2018, and then here was our top in 2021, and XRP is one of the only cryptos still in existence that did not make a new all-time high. Sorry, XR penises. Sorry, guys. You picked a shit coin, and it's the worst of the shit coins. Maybe it wins its little court case and the SEC and pays some fines and then just bursts to the upside and puts in a new all-time high. Sure. But right now, doesn't look good. Looks like a massive underperformer in this bull run. So if the bull run is over, XRP is fucked, because it's going to look like a dead heartbeat on the longer time frames, especially this time when it capitulates down another 90% and more cult members take their own lives or just give up on XRP altogether. What's the potential move to the upside for XRP from here? I don't know. Maybe like 78 cents, another 10%. I don't know, guys. It sucks. XRP sucks. Could have put your money in literally anything and it would have done better than XRP. So except for what is it? What's Gregory Marino's favorite coin? Buy at 400, hold till 150. And then talk about how you're still bullish. Good job, buddy. Cake. Um, yeah, above the 200 exponential, above the 200 simple, consolidating here. Looks like it wants to push up here. Next target, $21. After that, maybe $26. This is probably one of the better charts. This looks a lot closer to like something like our Ethereum. Yeah, and that's going to correspond almost perfectly with our Fibonacci targets. Yeah, I think very high likelihood those are going to be our next targets to the upside. Cake does look good. I think probably somewhere around here we're looking to, and then somewhere around here. So yeah, those are going to be our two targets probably to the upside, somewhere around like $20 to $21, and then like around $25 right there. So pancake swap, yay! Solana, this was a request right here. It's at resistance. Looks better than most. We only have a short history on this. If somebody knows too, I could actually look, but I'm just pulling up Finex, but there may be some longer history on this. I don't know if this was like just its listing on Bitfinex. February 2021. I feel like this is older than that. I don't know. Definitely some clear like resistance support areas here. I would think the 236 to the upside, $39, $40 roughly. Or again, if we just fib from the top to our wick down here, you know, right around the same area, the 618 and the 236. After that, I mean, maybe we get up to $45. This thing could really move. It could move. ADA, Cardano, still doing absolutely nothing. Looks like a bearish reset to me. The indicator oscillator floating up. You know, there's nobody buying this, but there's also nobody selling it. So, sideways. Great job. You're above your 200 exponential and simple moving average. You should be doing something. Instead, you're doing nothing. Bitcoin dominance. Again, you know, broke up, got rejected. Bearish looking candle off the 21. Looking like another bearish candle after that. We'll see on the weekly what to do. I think it probably closes in this range and just range trades between 46 and 49 for a while. Bunch of green histograms, hard buy coming out of the bearish control zone. Stokes are angled to the upside. Eventually, I think this is going to 55. So 55%. Bitcoin should gain dominance here. Whether that means Bitcoin selling off and alts are dying, or Bitcoin is pumping and alts are just kind of cruising up or sideways, only time will tell. But again, I think down is probably more likely. Well, statistically more likely. Total market cap broke back above, trying to cross the 821 back to the upside on the weekly. Coming out of the bearish control zone, very far away from the cross, getting the Stokes hard buy signal. Seeing our first couple weeks of green histograms, looking decent. Back up to 160. I think we could easily get back to 1.6. I think we'd easily get back up to 1.8 trillion, roughly 1.75 trillion. But again, I would look at that as a very, very strong resistance. And yeah, again, we got kind of rejected already there. I think probably this weekly low right here is going to be a really tough resistance to get through. Yeah, that's like 1.776. So, what time are we at? God, I feel like we've been going forever. 2 hours and 47 minutes. Yeah, it's been a bit. Riot, just doing whatever Bitcoin does. Mediocre at best. It's slightly underperforming Bitcoin. So, Coinbase doing nothing. Trying to put in some work here. Finally got some kind of bullishness. Looks terrible to bad. Looks absolutely horrendous to bad. I mean, there's still nothing to be had here. It's just Robinhood. Okay, so this is the title of the video. What was the title of the video? It was like Robinhood. Oh, what did I put? Robinhood screws retail simps and they come back for more. I mean, look, all these people trading on Robinhood got totally screwed out during like the GameStop squeeze, like couldn't trade, were only allowed to buy. They couldn't, no, only could, damn, what was it? You could only sell, you couldn't buy. They totally screwed everybody. They basically went sideways. Nobody was really interested. And then all the little like simpers came like running back in. It gaps up. gets a massive rejection candle right here. I mean, look, this is all people who bought. This is all people who bought. And, you know, granted, most of them got at least back to even here, but there's still, you know, somebody bought the absolute top of this, or their stop loss did, depending. But let's be real here. There's people that are already down 17% in this. So does it continue to the upside? Sure, maybe. Does it eventually just go down and capitulate and probably end up much lower than its IPO price? Probably. Does it get one more opportunity at least to come down here and fill this gap at like 46 bucks? Probably. Did it just screw a bunch of simps that's probably said, I'll never deal with Robinhood again. F Robinhood. Maybe they made some money. If you did, I would be taking profits. MicroStrategy, speaking of simps, Michael Saylor, the simp, or Saylor simpleton, friends, whatever. Yeah, it sucks. MicroStrategy sucks. GameStop, diamond hands, guys. We're never going lower. I'm never selling. Oh, shit. Oh, no. We're almost to my first target and the 200 exponential moving average. Next target, 200 simple moving average. After that, down here to like $66. GameStop looks like crap. Diamond hands. Who's selling here, guys? Who's selling? It's those shorts. They're flooding our GameStop. AMC. Oh, no. AMC's getting... They're screwing us. They're fudding us. Oh. All the AMC guys have poop in their eyes and pee in their guts. They were peeing in each other's mouths and throwing poop at each other. Now they've all got pink eye. They accidentally hit the sell button because now AMC's putting in a new low. So apparently someone does not have diamond hands, guys. I don't know who it is. I don't know if you want to get together, but I was told that AMC was going to $1,000 or $10,000 and that no one was selling until we hit at least 1,000. Someone's doing it. Someone's selling, or they're fudding our AMC. It's those naked shorts. Sorry, AMC apes, but it's not looking good for you. See you at $25 very soon. As predicted, AMC is still a piece of shit. I imagine soon they're going to report earnings. The earnings are probably going to suck. They're probably going to be terrible. The real question is, are they going to be so bad that more people sell, that your diamond turns back to coal? Or are they going to be bad but not worse than you guys thought, and then we're going to buy this thing back up? And by we, I mean dumbass people. Remember when I was telling you back here, take your profits, please, before this gets crushed? Remember when I was telling you back here, take your profits, please, before this gets crushed? Remember when I was telling you back here, take your profits, please, before this gets crushed? So, yeah. But again, it's not financial advice. I'm not your financial advisor. If you want to throw poop at your friends and talk about diamond hands and hodl things down to zero, by all means, feel free to. Bed Bath & Beyond, another meme stock, broke down from our sideways triangle and did exactly what we said, coming down here to form our descending triangle, trying to find some support on the 200 exponential and simple. I will see you at $23, Bed Bath & Beyond. Newegg, again, same exact thing. Told you so. We told you that the initial target was down here at 20 bucks. Then the target was $16.61. Looks like we have let go of that area. We have lost our support right here. I did expect some kind of dead cat bounce here, but it looks like we're going to be at $10.93 very soon. Should I buy some puts or sell some calls on Newegg? Jesus. I don't like... Look, let me tell you a little story about why you don't want to short things that are meme stocks and worth $10, because short squeezes or somebody else might come in and buy it. Not to mention, I actually use Newegg. I've purchased quite a few computer parts from there, even some of the ones that you are currently seeing in the little window at the bottom. But something's not right about Newegg. It had a high back here in 2010. It had another lower high in 2014. It then had a series of lower highs on the way up to 2020. It then had the most massive rejection candle ever and another lower high. So we have a high, we have a lower high, we have a third lower high, and now it looks like it's probably headed back down here to get absolutely dumped on again. Is there a buying opportunity at like $10.95? Probably. Will I take a scalp from that area? Probably, actually. But yeah, this looks absolutely terrible. That's why you don't want things to be meme stocks, because people get screwed and then they almost never recover. So DraftKings getting ready to report earnings. It's got that weekly cross on the 821 back here, barely hanging on for dear life. Got a hard buy signal here, came up and hasn't done anything. Maybe it just crushes its earnings and blows up to like $57, but I think more likely than not, DraftKings is headed to $37. So, yep, not looking good, guys. Not looking good. So yeah, we've ran pretty long on time here, and obviously my energy is running a little low. So let's rip through these commodities real quick in 6 minutes. Gold doing nothing. Got a hard rejection right here. The weekly looks bearish on gold. I do love gold. I'm not trying to fudge your gold. I'm not trying to hurt your feelings. Don't tell me about your fundamentals. The 821 on the weekly cross back here. We tried to save the cross. It got rejected. And now here we're losing it again. Gold is headed down to $1,739, after which it is probably headed down to $1,600. Gold is going to $1,600. According to a chart and technical analysis, if something does not change, gold is going down. Silver. Silverbacks. We're hodling. We bought premiums of $10 per silver. We just found out about silver recently, and now we're hodlers. Good luck, guys. The silver weekly chart has officially crossed to the downside back here at $26. It's looking like it is going to continue selling off. Silver will be very soon down at $24 again. After that, silver will be at $23. If something does not change, silver will go to $22, and then it will go to $20, and then they will continue to fudge your silver all the way down to the teens. So, hope you didn't pay too much of premiums. Sorry, silverbacks. Expected to continue selling off to the downside. Platinum looks terrible. It is underperforming. I do like platinum in the long run, and will probably I will definitely be accumulating platinum from below the $1,000 range down to probably somewhere in the 800s. So I will be picking up some platinum. Platinum, in my opinion, is the #1 most undervalued precious metal at the time. But we are 200 exponentials rolling over to the downside. 200 simple is well above our heads. Platinum does not look good. Could we easily bounce back up $100? Sure, but I think that bounce probably already took place, and we're just going to keep selling off. Platinum does not look good, guys. First Majestic looks bad. New lows, lower. Silver Juniors looks bad. Very bad candle, lower. USAS looks bad, very bad, lower. Tilray and the pot stocks. Looking bad, guys. Another rejection below our 200 exponential, rolling over, going much lower as expected. That's why we took our profits and got out on all these things. ACB looks bad, rolling over, going much lower. Canopy Growth looks even worse than anything, rolling over, going much lower. URA, uranium, looks bad, coming down to our 200 simple and exponential targets in like the 17 to 18 range, looks bad, rolling over. UEC, Uranium Energy Corp, looks bad, rolling over, getting rejected, about to lose the 200 exponential and simple and roll over. Next target 1.73, $1.73. CCJ, Cameco, Uranium, looks bad, rolling over, still above the 200 exponential and simple. I expect our measure move to play out soon, $14.30 to like $13 range, looks bad. Copper, looks bad, rolling over, high, low, lower high. I expect a lower low. CPER, copper index to $24, possibly $22, maybe $21. I do love me some copper. I do love uranium. I do love silver. I do love gold. I do love platinum, but not now. Not according to technical analysis. Lithium, still in this trade. LIT, lithium battery ETF, still expecting. This was one of our key targets based on our long-term Fibonacci levels. I might have to switch to a longer time frame. That is our 1.5 hit perfectly. 1.5 hit perfectly. We now have our like micro 1.618 target of $90. I am definitely not going to be greedy on this one. We're already up a substantial amount on this trade, and still looks very bullish. I mean, it's definitely putting in some bearish divergence though. Hydrogen. Oh look, we got our move. New hydrogen ETF, operating inside of a range for now. You know, again, we predicted it would come back up to the top of the range. It has literally just sold off since then. We're now at the bottom of the range. I do expect this to put in a new low. I do expect it to hit our Fibonacci extension targets to the downside somewhere between $22, $21.50, or potentially $21.26. We could very easily overshoot those to the downside and see an absolute decimation of this. We'll have to wait and see what happens though. But I'm definitely interested in this once it starts to carve out a bottom, but not anytime soon. Lumber futures looks terrible. We bounced at the 618, got rejected at the 0.5, came right back down to the 618, tried to get up to a 0.5, came right back down to the 618. This looks like it is getting ready to go lower. I mean, talk about screwed. 379 is our next target to the downside. We could easily find some support around like 458. Look, fundamentally and technically looks terrible. There's definitely some bullish divergence taking place right here. But was that it? I don't know. Maybe it gets some more upside potential. But right now it looks terrible. I'd like to see a third drive of bullish divergence and then buy it. Caterpillar, barely hanging on to the 200 exponential and simple. Descending triangle. Looks like it wants to just let go. See you at 184 bucks. Deer, slightly more bullish, but looks bad. See you at the 200 exponential and simple at 321. Could we easily get down here to the 236 at 291 or the measure move of 251? Yep, it's trying to hang on here. It's trying to move to the upside. There's infrastructure. Infrastructure, guys. We're going to build stuff in like 10 years. We'll build some stuff. Antero Midstream Corporation. We got the water. You want water? We got it. Got that H2O. No, we're selling off. 843 next target to downside. I mean, let's see what happens after that. Maybe $6. I don't know. Looks bad. These things are all rolling over. Cemex. Got that cement for you, bro. Need to make some driveways. We got it. You want to build a building? We got it. Looks like it's basically just like triple top and fell out of the same channel that every other one of these industrials is in. Looks like it wants to sell off bad. 602 or 524. Definitely seeing some divergence. Cleveland Cliffs. Okay, so we got the move we expected back to the upside. Put in the new high. Tried to reclaim that level. Let's see, does it hold? Or is this just one of these guys where we basically break back inside the range and then it fails? I would expect this down at $15 very soon. If not, $12. You know, we got some key targets along the way. Some key fib levels. We could see it as low as $7. I don't know if it gets down to $7. I think realistically $12 is where it starts looking interesting again. But this could very easily go sideways to down for another year. Ford broke down from the channel. Tried to save it a bunch of times. Same channel, breaking down. I expect this move to the downside. Initially, I would expect some support along our little green, like descending, broadening wedge. But in all reality, what's going to happen? Maybe we save it at 12, you know, easily get down to like $9. This looks terrible. I'm out. I'm out like trout. Sorry, Ford. Peace. Hasbro. Okay, so this is what we didn't want to see. Finally breaks out of this range bound area it's been in forever. You know, basically for a year at this point in time inside of like this range, or at least like this year inside the range. Finally breaks out on some nice earnings, on some good news, and, you know, basically is losing that area. Barely holding on for now. I expect this is probably going to come back down inside the range. I think this was probably our throw over. I do like this long term. It is crossing above the daily, trying to get some bullish moves, but damn, Hasbro, what's up? Talk about underperformer. Underperformer more than meets the eye. That was a toy joke, by the way. I don't know if they actually make Transformers, but yeah, so we did it, guys. Sorry I got a little low energy there at the end. This was a long stream. I also am rather tired. 3 hours and 4 minutes. We did pretty good on timing. I appreciate everybody that showed up. Appreciate everybody that stayed to the end. Hope you got what you were looking for. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. Yeah, I made some announcements in the group. Got some fresh stuff coming out for you guys. Hope you're excited. So, yeah, definitely get excited. Got some awesome videos coming out probably this week, at least the first one, and probably the second, possibly the third. And then also tied in with the first video, the first of the like legit lesson series, up to date, like short and simple videos, is going to be a new indicator that I'm working on. It's going to be exclusive for group members, at least at first. After a while, I'll probably give it to everybody. I don't know. We'll see. I may just keep it to the group members, but I am going to, the first video, it's not like a secret. The first video is basically just identifying trend and talks about what I was doing today about the 200 exponential moving averages, 200 simple moving average, and the 821 cross. And then the indicator is basically just an indicator that shows you those things and changes colors when you should be bullish in the trend and changes to a different color when you should be bearish. So it's basically just a simplified version of the strategy, which I use to great success. And in my opinion, the number one thing that anyone should be doing when they first start trading is trading moving averages and trading with the trend. Obviously, based on the name of my channel, Crypto Trend Trader, although I use it for everything, including traditional markets, cryptocurrencies, and whatever else you want to look at. So there we have it, guys. I hope everybody enjoyed the stream today. I will see you on Sunday night for our Sunday night market look ahead. So make sure you're around at 8 p.m. Eastern Standard Time on Sunday. Appreciate you guys being here today for our Wednesday midweek market stream, whatever. DXY still gaining strength here. Crypto trying to cross the 821 back to the upside on the 4 hour, looking decent. The daily looks decent. Weekly starting to show a little love, but let's not get too excited on these things just yet. It really looks like we're about to enter into a bear market, and this is like the throes of death coming out of crypto. So, and we're seeing a lot of weakness in traditional markets, commodities. Basically, it looks like there's people who've been calling for a big sell-off since like 2000. Okay, and been saying that gold was going to the moon and stocks are going to zero, and have been sitting out since then. So try not to sit out for the next 20 years waiting for a move to the downside. We'll keep scalping on the way up here. We're obviously always going to have a long-term investment portfolio, but right now, as far as I'm concerned, not a ton of great trades to the upside in most of these markets. You know what, the way I look at it is, if once a month we can have a series of nice trades, or a series of nice trades every month, where we use somewhere between 10 and 50% of our capital to make somewhere between 20 and 40% of our portfolio in gains, we are doing pretty fucking good. So again, we don't need to be making a million trades a day. We don't need to be trading stuff that doesn't look great. The best thing to do is trade conservatively, protect our gains, protect our principal, you know, take the perfect trade setups when they arrive, trade obviously with the trend, use our technicals to make our trades, and make sure that we take profits along the way, not be greedy fuckers and give it all back to the market. Because if there's one thing I know, easy come, easy go. But as long as we have our solid trade setups, we use risk reward, we use position sizing, and we trade with the trend, and use our clearly identifiable, clearly repeatable, you know, trade setups, patterns, and technical analysis to gain an edge on these markets, we will continue to succeed. We will continue to outperform even Kathy Wood. Even though every once in a while she'll beat us on one single trade, and she'll actually do well on some meme stock like Robinhood. You know, can't win them all, guys. So, but there we have it. It's going to wrap it up for today. Appreciate y'all tuning in. Sorry about the apes. Sorry about the gorillas. Sorry about the silverbacks. All your stuff looks like shit, and all your monies belong to me. But that's it, guys. Crypto Trend Trader, and I'm out of here.